All right. Hello, everybody. Welcome back to another episode of the Market Close. We are here today, Thursday, October 31st, and it is 3:47 p.m. Halloween. Happy Halloween to everyone that is out there. This is going to be a very, very important earnings day because we've got two of the largest companies in the world called Apple and Amazon that will be reporting their numbers in basically 15 minutes. And those results are going to be very important to determine the trajectory of the broader stock market. So we've got a lot going on top of the fact that we've got Apple and Amazon, along with Intel, which is a name that's going to be important. This is the first red day the S&P has had in a while. And we've had a little bit of red here and there over the past couple of weeks. We haven't been promised the type of 7 to 10% decline of election volatility you would see in September or October. The worst we got in September was down 4%, then spent the next 3 months or 3 weeks rebounding with the 50 basis point cut by the Fed. And then October, every time we thought it was going to be bad, October just ended up being really good based on some of the macro data and Q3 earnings that we've seen. Today is not one of those days. Today, we have an S&P 500. As you can see right here, down 1.4%. It was down about 1.6%. We were getting close to that 569 range. Now we're at 571. We got 12 minutes and we'll see how the market closes. But overall, relatively red day for the markets. And, you know, my sort of high level thoughts on this is that this is a good thing. It's important for us to see a little bit of a pullback. Qs are down 2%. Palantir's down 4%. Hood is taking it on the chin right here. Robinhood 23.74 down about 15.8%. We'll talk about Hood in a bit, but Robinhood as well getting hit. It did open at like 25, 26, tried to stay above 24, and it looks like today it's going to end just in this 23.70 to 23.80 range after they had earnings yesterday. The cruise lines were green. Now they're red. Coinbase as well, taking it on the chin, down about 13%. Bitcoin kind of stable, down 2%, but still above 70,000. So Bitcoin's doing okay. And NVIDIA is down almost 4% on the day because of one of their customers, SMCI, being down another 12%. Because their public accounting firm has left them. SMCI was also down 30% yesterday. That means it's down 42% in the past couple of days. So in general, we've got a lot of volatility going on today, a lot of volatility that we were promised, honestly, throughout the month of October. It's happening on Halloween. And it's kind of funny that it's happening on the last day of October, but that's, you know, what ends up happening for the market. I looked at some stats today, and on average, over the past, I think 10 election cycles, the week before the election, so leading into the election, which I guess this would be one of those weeks, is the S&P is up 0.76%. And the week after, I think it's up 0.5%. So on average, you have some red weeks here and there, but in general, you tend to be up about 1% and then up about 0.5% the week after. This election is going to be very different in terms of the volatility that it's going to put out. Trump, Harris, it's going to be something that the market has to figure out to interpret. But so far, we are facing a little bit of that volatility today on basically one of the last 3 trading days before we have the election. So there we go. We got a lot to get into. Thank you, everybody, for being here. If you haven't figured out my outfit yet, I am Alex Karp and Jensen Huang. The real ones that are actually creative on this planet would have figured that out. They would have seen the leather jacket. They would have seen the hair. They would have made the connection. That is a legit outfit. Some people said it was a lame outfit. I thought it was creative. So I guess, some people's perception of lame is my perception of creativity, but nonetheless, that is the outfit that I'm wearing. And now hopefully we just got to see if Tim Cook and Andy Jassy can not mess things up and keep things going. So we're going to do a little preview of those two companies because those are the biggest ones. And then we'll keep going from there. In terms of what I bought today. So I bought 200 shares of Hood at 24. I also bought some options of Hood. So I am looking at the $37, $40 spread on Robinhood, buying the 37, selling the 40 for January 2027. Those options today were down almost 80%. And look, do I think Robinhood's $40 by January 2027? I mean, yeah, I do. I thought it was getting closer to 35 by like February 2025. So long dated leaps is what I like to do. I like to do spreads because you get to kind of save your long call with your short call when things get volatile. And I don't know if 23 is a bottom right here or 23.50 is a bottom, but I basically bought them at 23.50. I got them at about 60 cents a pop. So that's one of the options that I engaged in. In total, my portfolio at the worst today was down $68,000. Now we're down $51,000. So it's been a very fun day in terms of looking at the portfolio. These are some of the days you gotta just close the brokerage, buy the dip, and then just move on and not look at it. And so that's kind of what I had to deal with today. But that's what I bought, a couple hundred shares of Hood and then some of those options. going into January 2027. Okay, let's do a preview. What do we got going on with Apple? So Apple down about 1.19% right now. The street is expecting $85.7 billion of revenue. Sorry, no, $94.5 billion of revenue and 1.60 of EPS. So they are expecting, a decent earnings per share, along with around close to $95 billion of revenue. If Apple can beat that, then that would be really good. Amazon street's expecting $157 billion of revenue and $1.14 of EPS. So here's the poll that we're going to do today. We're not going to do an Apple or Amazon dump. We're going to do which one does better post-Bell, Apple or Amazon. So which one are you more bullish on to pump, essentially, is the question. And let's see what you guys think. If I had to guess, I would say that I would say Amazon, dude. I think Amazon's operating margins are probably going to be decent. And if those operating margins, I don't want to say they're probably going to be decent. I think they have a chance to be decent, given it was not holiday season, but getting close to holiday season. They had a bunch of big deals going on, all that stuff. And if those operating margins are decent, then I think it's going to be good. Bay Ray says, I'm way too heavy in Amazon short-term calls right now. What is the strike, Bay Ray, and the expiration? I'm curious on those Amazon calls. A lot of you guys tend to agree, 82% on Amazon versus Apple. The only fear I have about Apple right now is that, look, iPhone 16 demand, Apple down about 1.4% right here. iPhone 16 demand, no one knows. Like, no one knows. You read the bank reports, they're saying it's fine. You read some of the analysts that have been covering the company for like 5 years, or sorry, almost 15 years. They're like, no. Apple iPhone demand is like, we got to cut the estimates by 10 million. So I don't think anyone knows who the hell to believe. It's one of those, to me, honestly, coin tosses where someone's going to be right. And we're going to find out today in about 15 minutes and see kind of what Apple says. So if I had to bet, I think Amazon does better than Apple. But again, if Amazon's operating margins suck, then that's going to be bad. Amazon right here down 3.4%. That was the move Microsoft had after the bell yesterday. So Amazon already having kind of a earnings hit, even though they haven't reported yet. I actually like this because that means being down 3.4% going into the bell. Any good numbers, maybe you go to the upside versus being up 3.4%. Apple is Apple as well, down about 1.5. Microsoft is down because the street is upset about their explanations of AI. So I was reading a couple things today about Microsoft. Microsoft's AI business in terms of revenues is going to do $10 billion in 2 years. It's going to reach $10 billion on a trailing 12 months revenue. The cloud business took 10 years to get to $10 billion of revenue. So it's not like there's not AI momentum in Microsoft. It's the lack of clarity is what I'm getting from the street in terms of Copilot, the adoption of Copilot, and the actual ROI from all these AI workloads that they're bringing onto the marketplace. Cloud business is doing great. I don't think any of the analysts are upset about that. They're a little bit more upset about just where's the ROI from AI, which is kind of fair, but it's also kind of irrational because Microsoft said, hey, this is a multi-year process. You got to give us time. Same thing that Meta said. So I don't think it's going to be, that big of a deal in the long term. I think this dip is, if you're long-term bullish Microsoft, it's probably a dip you want to engage in, barring the rest of the market doesn't take a hit, because you haven't had these chances to get Microsoft in a while. Below 400, I think would be the real dip on Microsoft. But again, you've got too many buyers that are very long AI, and Microsoft's a big thesis component for their AI holdings. And as a result, it would be hard for it to get into those low 380s. SoFi had a pretty good day. SoFi 1121, down about 0.13%. So SoFi kind of holding up, being very resilient in the midst of all the redness that we're seeing. NVIDIA down about 4.2%. Palantir as well, down 4.68%. Thesis for why Palantir is down: the insider sales are probably starting to hit more of the news outlets, and people are seeing those sales and they're getting scared. They're selling. On top of that, Microsoft going down, NVIDIA going down does not help Palantir. And the reason NVIDIA is down is because SMCI is down. So a lot of this is interconnected. If we look at the semis right here, all the semis, if you see the left-hand side of my screen, are down. SMCI, 12%, AMD, another 3%, NVIDIA, NVIDIA almost 5% right here. Lam Research down 2, Dell down 4, Taiwan Semi down 2, Marvell down 3, and Micron down 4. Does anyone feel the same thing that I'm feeling right now, which is that this is kind of healthy? Like it didn't make sense for us to keep going up and up and up and up. And especially we got this election going on. I'd rather have this dump that we're seeing right here today. And it's not as big of a dump on the major indices, but it's a nice little 2-3% dump before the election versus after. I think going into the election at all-time highs is much more scarier than like being a lot more chilled out before the election. And then the market can interpret the election. Then we keep going from there. Doug says this is very good. I would agree. I definitely think this is very good. Did you buy more Hood today? Yes, I bought more Hood. So Vlad did do an interview on Twitter Spaces. I was listening to that today as well. Didn't say anything that different than what we heard on the earnings call yesterday. But essentially just said that, this was a seasonal thing across their business. And he kept highlighting that October was a very good month. So that tells me that he sees a lot of momentum going into Q4. We'll see those October numbers in about a week, and then we'll get November numbers, and then we'll probably be able to figure out what happens going into Q4. Again, the story with Robinhood is that the contra revenue, aka the money deposits, it was way higher than expected. It was double what we thought. And that messed up a lot of valuation models. And as a result of that contra revenue messing up a lot of valuation models, that's why there was a mismatch with the street, which is okay. Look, Robinhood at a $20 billion market cap with $5 billion in cash means you are paying $15 billion for a business growing 37%. I mean, it's one of those things where, okay, I'll take that. With a company that also just bought back 5 million shares, and a company that has a crypto bull run and a broader market rally towards the end of the year. If those things happen, contingent on if those things happen, Robinhood's at the epicenter of that. So to me, I like that dip. I engage in that dip. I buy that with my eyes closed, but it does suck, seeing it down 16%. It is what it is. And, honestly, they're down 16% while the entire market starts to fall. So it was one of those days where I guess reporting the day before the market was going to decide to take a crap, definitely not the best for Robinhood as well. Tesla also down 2.8%. Occidental up a little bit. Root, that stock insurance company, was at 118 this morning. Now it's at 67. So it was up like 140%. Now it's up 67%. Bookings is up 4.8%. Twilio up 14%. Waste Management up a little bit. And that's pretty much it. Pretty much everything else throughout the entire day has been a bit of a red day. Bitcoin is just above 70,000. Bitcoin going below 70,000 would be a little psychologically bad. We'll see if that happens. But Bitcoin as well taking a little bit of a hit. Yeah, look at the S&P. There you go, right below 570. Looks like it's going to close possibly right below 570 at 569.20. Intel as well. That's going to be very important. So let's make the watch list real quick. This is earnings 1031. Intel, let me know if I'm missing companies. The three ones that I care about, or that I think are like the most important here, are Apple, Amazon, and Intel. But let me know the others. I'm sure I'm missing some that we also have to look at. And this will be important. Apple and Amazon. I think Apple ends up being at 415 if I'm not wrong. Amazon usually is at 405. So it'll be a couple minutes of waiting, but then we will get the results. And then we're going to see what these guys have to say. Intel as well, down about 3% right before the bell closes. All right, here we go. Happy Halloween. It's been a spooky, spooky market. Now we got to see how big tech earnings do. Thursday, October 31st. Thank you, everybody, for being here. The stock market is now closed. All right, markets are closed, and now we wait. Now we have to wait. Intel was up a little bit just for a second, and then Intel went down. Intel, no, is it still up? Yes, Intel is still up right there. Amazon as well, moving just a little bit after hours. And then you got Apple as well, up about 0.22%. My mic is being a little weird right here. Let me just put it down for a second. Okay, cool. We should be good. Okay, so let's look at some of the other stuff we got going on. Palantir, before we get into all the numbers, Palantir 41.57, Amazon 186, Apple 225, SMCI 29.11, SMCI down again after hours. Of course, SMCI continues to be down. Where is PayPal? We're going to get numbers in about 5 minutes, folks. PayPal 79.44, SMCI again down. Amazon. Oh, Amazon's up. Wow, Amazon. It looks like, well, let's wait to see if this is not a pump fake. Amazon up 3.4%. Please don't go down, dude. This is what Robinhood did yesterday. Let's see if Amazon can hold. I'm not going to get excited yet. We already got burned yesterday seeing that happen. It looks like it might stay. It looks like it might actually stay. And I think we can hold on to this level. Up about 3%. All right, let me see if I can get these numbers. Let's see. Can I get these numbers? Here we go. Amazon, it's holding on, folks. It's been about 2 minutes holding on. Amazon, oh, wow. 143 versus 116. That's a beat. Net sales 158 versus 157. That's a beat. They beat by $1 billion, and then they beat by about 25 cents on EPS. Fourth quarter net sales, they see to 181 to 188. That's a beat on guidance. The street thought they would do 186. That's a beat on the high end. Fourth quarter operating income, 16 billion to 20 billion. The street thought they would do 18 billion. So that's also a beat on operating income. Sorry, not operating margin, operating income. Let me see if I can pull up the operating margin real quick. If that number is good, then we are going to see potentially some momentum. Amazon now 4.6%. We don't have Apple yet. I don't think we have Apple yet. Intel is also up 9%. Whoa. Intel. Not bad. 2350 on Intel. Amazon's holding, baby. Amazon's holding. Let me try to get the numbers on their operating margins real quick, and then we'll get into everything else. They did not publish it. Okay, Amazon's probably going to take 5 minutes to publish it. Amazon's going to take a minute. Intel, 9.2%. Let's see if we can pull that up. Intel's up. Not bad. All right, let's see. Let's see if I can get this ready to go. Intel now 11%. Goodness gracious. Intel's doing its thing. Okay, we got Amazon. Let me pull this up. And then let's look at Amazon. Let's look at Amazon. Here we go. I'll get Intel's numbers in just a second.
Great, but good on because people shop online to find the better deals. So
43
on Amazon. Kate.
Hey, John. So it was a beat for the third quarter for Amazon, at least on the top and bottom line. AWS was in line in terms of the growth rate. EPS, $1.43. That was better than expected. We also had revenue of $158.8 billion. Well, and then that AWS segment sale, this is important, 19% in line with street expectations. You can see stock up more than 5% here. We're looking through the results, John. We'll bring you any highlights, but we'll be right back to you with more details. But those are the big headlines right now.
All right, Kate Green on the screen. Let's bring in Mike Santoli, senior markets commentator, with us as well. There was a lot of...
Okay, so Amazon beats. Now we're looking for Intel. Bay Ray, what was the strike on your calls? Maybe I missed it in the chat. Put it again. So Intel right here. Intel beat. Oh, wait, no. These are the expectation numbers. We need the actual. All right, here's the actual number. So they missed on EPS. Oh, my God. Hold on. How is Intel up 10% off of a... Dude, the street wanted them to lose 3 cents. They lost 46 cents. That's not the best. Revenue, 13 billion, 13.28 billion. Okay, so they beat on revenue slightly. They missed on EPS badly. What does the street like about this? That is very surprising, dude. Unless the street already knew that there was going to be this type of a miss right here. Fourth quarter revenue guided to about 14 billion. The street thought they would do 13.5, so guidance is good. I guess you can make that argument. CEO says our Q3 results underscored the solid progress we are making against the plan we outlined last quarter to reduce cost, simplify our portfolio, and improve operational efficiency. We delivered revenue above the midpoint of our guidance and are acting with urgency to position the business for sustainable value creation. Restructuring charges meaningfully impacted Q3 profitability. Okay, so the profitability miss on EPS was more so restructuring charges. The street is looking past that right now, and they're looking to the healthy guidance that Intel gave. Also, Intel was down 60% year to date. We have to remember that as well. That's what leads Intel to probably getting a little bit of pop on any good news. Intel, $24. I mean, look, it was at 18 on the lows a month ago or 2 months ago. So if you took a gamble at 18, it's at 24 right now. Not too bad. Amazon is the story, though. Amazon holding 5.3% at 196. We know Bezos is waiting at 200, but maybe the street can look at these numbers and feel that 200 is still worthwhile to get to, even if we got Bezos waiting there. Apple is not out yet. 195 expiration call, 1220. Oh, that's good. All right, so you're in the money, Bay Ray. I think by December you'll be in the money on those 195. You got holiday season coming up. I think that'll be pretty decent. And that strike is not too ambitious either. Okay, here we go. We got Amazon's numbers. Amazon, I'm looking for operating margin. That's what I care about first before anything. Let's see if I can pull that up. Operating margin. Oh my gosh. It's 11%. There you go, folks. 11%. That's the headline. The headline is Amazon has posted their best operating margins since... Okay, technically since Q1 2024, but realistically over the past 2 years because they got this 10.7% 10.7% number back in 2021. So realistically, since about 2021, they have had their best operating income margins at 11%. And that's why Amazon is up, in my opinion. That's the actual reason Amazon is up right now, because the street's like, oh, they're making money, which is not bad. On their retail business, let's see if we can find those margins. I might have to look through some stuff to find that stuff. But if that's 11%, I don't think that's led by AWS. That's probably led by an incremental increase on the retail margins. Last quarter was like 5.3%. If they got that to 6%, then that would be pretty damn good. Okay, we'll look for that in a second. But that's the big number, folks. That is the big number. Operating income on a TTM basis is $60.5 billion. Again, this margin. So the reason I thought that it fell 10% last time is because you see how it got to 10.7% 2 quarters ago in Q1. The street was happy because the quarter before that quarter, it was at 7.8%. So 7.8 to 10.7 is a hell of a beat. And then they went down last quarter to 9.9. And so the street was like, what's going on here? Why can't you keep these margins stable? Now they're back at 11%. If next quarter they get that close to 12 or 13, this is a business that's actually putting up some really decent numbers, which is not bad. All right, let's see what the CEO said. As we get into the holiday season, we're excited about what we have in store for customers. We kicked off the holiday season with our biggest ever Prime Day deals and the launch of an all-new Kindle lineup that is significantly outperforming our expectations. Put in the chat if you guys read off of a Kindle. I forgot a Kindle was a thing. So put in the chat if you read from a Kindle. And there's so much more coming, from tens of millions of deals to our NFL Black Friday game and Election Day coverage with Brian Williams on Prime Video, to over 100 new cloud infrastructure and AI capabilities that we'll share on AWS reInvent the week after Thanksgiving. AWS revenue was 19% increased at $27.5 billion. Again, Google was at 35%, but Google's off of a smaller base than Amazon. North American sales were $95 billion. International sales were $35 billion. Total net revenue $158 billion. Operating income $17.4 billion. North America 5.7, international 1.3, and then AWS, which is really the money printer for Amazon, $10.4 billion. Last year it was $7 billion. So they're making $3.4 billion more than they did last year just on that beautiful cloud business for AWS. There you go. Not bad. Not bad for Amazon. Amazon holding that 5%. I think it deserves to hold it. And then you got Intel right here at 11.8% right now. All right, let's see if we can get some more coverage on Intel and see if we can get something here. Okay, so no Intel coverage yet. We're just looking at Amazon. Let's look at some of the other companies that reported as well. Apple is not out yet, so we're still waiting on Apple. I'll get some of the other ones here. Matt Money says $600 billion annual run rate growing at double-digit pace. That's incredible. 19% growth on something that's doing $27 billion a quarter at this point, $600 billion TTM. It's pretty damn incredible just for what we're looking at for AWS. Oh, $600 billion is for the total revenue, but AWS in general doing at this point going to be doing 130, right? Or 120, close to 30 billion a quarter. 30 billion a quarter on AWS. 120 billion TTM, and then you got 600 billion annual run rate for the entire business. The only company that does as much revenue as Amazon is Walmart. So it seems like, they're the ones that are kind of really controlling the retail side of the business, but Walmart doesn't have AWS. All right, some of you guys are saying you own Kindle. Someone says he's an author. I like Kindle. People use Kindle a lot. I love my Kindle. I read on Kindle. Interesting. Okay. I'm a little biased here because I don't really read books that much. I read a lot of articles every day, okay? And I listen to a lot of podcasts. I just don't read books. There was a phase where I read a lot of books like 5 years ago, a lot of motivation, self-help stuff, and then I just stopped reading books. I'm not a big fiction guy at all, to be honest. I'll watch a documentary on Social Security before I'll read a fiction book, but I'm happy that those who read are using the Kindle. All right, what else do we have today? What other earnings do we have? Atlassian has earnings. Let's put that on the watch list. Team, this is a project management software. Team is up 17%. Okay, looks like they beat. Justin says, surprise, you have the attention span to read a book. That's a good point, dude. I'm going to try to read a book one day just for fun and see if I can get through it, because it's a little tough with the attention span. Earnings per share, 77 cents versus 65 cents, 1.18 billion versus 1.16 billion on Atlassian. This stock right here up now 17% on the day, which is not bad at all. Let's get a little bit more coverage on Amazon as I'm getting these Intel results, and then we will keep going from there.
And other hyperscalers are spending a lot on CapEx.
Yeah.
It is true. Now, obviously, they have many levers to pull if they so choose on margins. And so that, I think, reinforces the idea that it's a pretty intact fundamental story. The guidance was more or less, bracketing or validating the current consensus and maybe suggesting a little bit of upside. It will never not be amusing to me that, 1/3 of the way through the fourth quarter, their revenue guidance has like an $8 billion span for the fourth quarter. But that just shows you the scale of the business and how it could break either way. This stock has been really kind of consolidating sideways. It was 185 last April. It was 185 at the close today or thereabouts. It was 185 at the high in 2021. So there's room here for, I guess, upside surprise as the numbers have increasingly fallen to the bottom line. And AWS, at least right now, at least not knowing exactly what they say on the call, no reason to really find too much fault with those results.
Overtime is full of surprises. Just about every day, something in this hour surprises me. Kevin, thank you. Mike Santoli, going to see you in just a little bit. For more on Amazon, let's bring in Tom Forte of Maxim Group.
Okay, so we're going to have the Amazon call at 5 p.m. I'll be streaming that, and we'll listen to Amazon. I think Apple's at 5:30. So we'll see what Amazon has to say. But, this is a hell of a quarter. This is a really, really good quarter by Amazon. As Matt Money says right here, at 10% growth, by 2030, Amazon will be doing $1 trillion in revenue with even an 11% operating margin. Imagining that doesn't increase, that's $110 billion in profit. I mean, it's one of those things, dude. When we have a company that does $1 trillion of revenue, I think the market's going to be looking at that like, wow, that's incredible. And you would imagine, that's assuming Amazon doesn't have any other new products over the next couple of years that they increase. Like just this core business growing steady is probably going to lead to that level of growth. Intel still holding up 12%, Amazon 4%, Apple slightly up after hours, but we don't have the results yet for Apple. Now we're waiting to see what Apple does. So Andy Jassy did what he needed to do to keep big tech earnings afloat. Now we need Tim Cook to cook up some good results. Now, what's really interesting about this is Meta crushed. Expectations were too high. That's why they fell. Microsoft crushed. Expectations were too high. Sundar crushed with Google. He got rewarded. Tesla crushed. He got rewarded with Elon. Amazon just crushed. I think the last two that are left are Apple and NVIDIA. And we all kind of know NVIDIA is going to crush. We know Blackwell demand is going through the roof, so that's fine. The last biggest mystery now is Apple selling any iPhones? And if they're selling enough iPhones for the street to be excited enough to buy a stock at a 34 PE that's not growing 15% the way Amazon is. And so that's the final mystery. I think even if Apple were to collapse like 5%, which it could happen, it couldn't happen. I don't know if that puts a dent in the broader market. Like that'll hurt the market. I think that money will just rotate away from Apple at that point and go to other stuff. But if Apple can go up 5% on some really good results, it's good for the whole market. Like the market just likes it when Apple is doing well. And the AI thesis for people that are long AI is going to be important. You need consumers to adopt it. And the iPhone is probably going to be the way that most consumers get into it. So let's change the poll right now. We already got Amazon. We had 81% of you say that Amazon will outperform Apple. Now let's do the Apple dump or pump. And let's see what you guys say there. Apple dump or pump. I almost spelled pump as pimp. I'm happy I caught that mistake right there. Amazon's a good stock to have in your IRA, 100%. I think in a retirement account, you just put it there, don't look at it for the next 10 years, and I think Amazon does decently. Oh, I will be reading Karp's book. That's true. Now, so Karp's book, I think I'll be able to get through because I actually care about what Karp talks about. Like you got to have a mix of technology and philosophy. I mean, there's like interesting stuff there, so I think I'll be able to read that. If I really can't pay attention, then I'll just get the audiobook. I wonder who's going to narrate the audiobook. That's the big question. Because if Karp's narrating the audiobook, then I'm really definitely gonna have to listen to the audiobook instead. But that is one of the first books I'll be reading in a long time. Okay, we got 67% saying dump, 34% saying pump. So most of you are being a little bit more bearish on Apple over what other people might think it might get to. Definitely over what Dan Ives would think what happened with that. You should start with Cat in the Hat. That's a good point. Okay, cool. What else do we have right here? Let me get Intel's numbers because I didn't actually get Intel's numbers fully. I saw some of them. Let's pull up Intel's IR. Who owns Intel? Put that in the chat as well. I know TJ owns Intel. I think he has covered calls at 25, so his covered calls are still good. but his shares are probably happy that Intel is going up right now. Third quarter revenue of $13.3 billion. Third quarter GAAP earnings loss per share of 388 again, 46 cents. Again, some of that was due to the restructuring charges, which is okay. Gross margins down 27.5%, which is a little bit of an improvement. Operating margins are down 68.1 basis points. Earnings loss per share, again, we looked at 7 cents. In the third quarter, the company generated $4.1 billion in cash and operations and paid $500 million in dividends. There's going to be no dividends going forward, so the dividend is cut. This was the last quarter to get your dividend, and after that, they're going to just try to accelerate the growth of the company. In the third quarter, the company made significant progress on its $10 billion cost reduction plan. They did lay off a lot of employees, which is another reason their costs are coming down. The plan aims to drive operational efficiency and agility, accelerate profitable growth, and create capacity for ongoing strategic investment in technology and manufacturing leadership. These initiatives include structural and operating realignment across the company alongside reductions in headcount, operating expenses, and capital expenditures. As a result of these actions, the company recognized $2.8 billion in restructuring charges. Okay, so the street's actually happy that they have this $2.8 billion restructuring charge cost that caused them to miss EPS, because what it means is that in the future, they're not going to have as many costs, and it's kind of a one-time thing, which should dramatically increase EPS going into Q1 of 2025, which is a good thing. CEO of Intel is on CNBC. Okay, let's pull that up. This is Pat Gelsinger. Let's see what he has to say on CNBC. All right, here we go.
Not used to seeing a non-GAAP EPS loss here, but this has to do with equipment bought COVID timeframe, 10 nanometer that you just couldn't use. Is this over with this scale of these types of charges, many of them non-cash?
Yeah, thanks, John, and always a pleasure to chat with you. And overall, I just say we had underlying strength in the business this quarter, but we had the one-time charges that were consistent with what we indicated on our last earnings call, the major restructuring that we have done, the people actions against the business, and as you say, these one-time charges for the Intel 7 equipment. And simply put, we had too much equipment, somewhat induced by the COVID era expectations of a much larger PC, business at the time. That equipment isn't useful as we move to the EUV nodes, Intel 3, Intel 18A. So we did take this one-time write-off associated with it, in addition to the impairment charges, which are largely accounting charges that are affected this quarter. But when you look at the underlying business, great progress on products, on foundry, a beat and raise. So obviously the markets are responding positively, but our view is, we have a lot of work to do, and we had a lot that we got done this quarter. So a really solid quarter of execution.
Give me the give and take between the client business and the data center business. Client computing was just about in line, slightly less than the consensus, though I think after AMD, investors might have been expecting that. Data center actually did a little bit better than a lot of analysts were expecting out there. What did you see demand-wise?
Yeah, overall, our client business, we made significant adjustments with our customers to lower inventory levels. So we go into the rest of the year with a very good inventory position and a very robust product line for our client business overall. Clearly different segments of the market, like the desktop products, we weren't quite as strong this quarter, but overall, we're on it for the AI PC, our leadership there, very strong launch of Lunar Lake, our Core Ultra product, that just has really set the world right thither on just how strong that product is, battery life, AI performance. And on the data center side, a little bit better than was forecast in that business. And clearly our Xeon 6 product line that is now in the market is starting to gain momentum there. And our overall position for the Xeon as the AI data center CPU of choice has definitely been a positive for that area of the business as well. Overall, very solid product execution.
Quickly, I want to go back to something that you just said, because last quarter you said that you expected Q3 to be tough on inventory, but then that would set you up well for a bounce or uplift in Q4. Has that worked out as well, less well than you expected so far?
Yeah, I think overall the PC market may be slightly smaller right, as people are looking at the finish of the year. That said, I think everybody is expecting growth in the overall PC market for next year based on a major Windows refresh, AI PC, a bit more global strength, China economy recovery. So overall, we believe we're very well set up for Q4 and for next year in the level of inventory and our product portfolio with our customers.
Okay, now I'm always asking about it. Tell me about Gaudi 3. I believe that was launching in Q3. You've touted that it delivers 2x.
Gaudi 3 again is their big competitor to NVIDIA's best GPUs.
Performance per dollar on inference and training versus H100. That said, you are selling it for less, of course, and NVIDIA does have Blackwell out. How does the reception look for that product now, long awaited, as you're launching it?
Yeah, Gaudi 3, strong product. And the efforts in having a strong set of use cases, you've seen that we announced with the IBM, their Gaudi 3 in the IBM AI cloud. We're getting good reception from that. And early market uptake is very strong for Gaudi 3. And we're really focusing it on what I'll call the enterprise TCO inferencing-centric use cases where Xeon plus Gaudi really deliver a compelling offering for enterprises who really are now saying, that high-end AI cloud training is great. How do I use it, or how do I inference with it? And that's where we're seeing our strength on both Xeon and Gaudi 3.
Now let me shift.
We got some breaking news, folks, on Intel. They are laying off 16,500. Now I know why the stock is up, dude. Now I know why. I was wondering, why is it up 15%, 13%? They didn't put this on the press release, obviously, but they're laying off 16,500 people after laying off 19,000 people about 6 weeks ago. So that's actually why I think the stock is up right now. You never want to see people get laid off. And the other thing that's weird about this is that, didn't the government give them a lot of money to protect jobs? I know it's to invest, but to also not fire a bunch of people. But, I guess this is what they have to do to remain profitable. But that's what we got going on right now with Intel.
Back to client for a moment, because AI PC caused some turbulence in your numbers last quarter, the costs associated with shifting some production on that. How does that look to you now based on the PC market being a little bit weaker overall than some expected?
Yeah, overall, we feel the guidance that we've set, the inventory levels, the strength of the product line, exactly as we would have, forecast. This is a good business for us. We're the clear market share leaders in it, and we're set up well with our product line for next year. Obviously, the margins aren't as strong, for that, and there's some unique things with Lunar Lake, but those all get corrected when we move to our fourth product in the AI PC category, Panther Lake, where we bring wafers home and we run that on Intel 18A. And we've already been hitting key milestones in its development. And as we launch that late next year and then volume deliveries of that in 26, we feel very good about our overall AI PC category and the multi-year view of its ability to both have great market share and great margins.
Your CFO just telling me a few minutes ago that X out the restructuring charges, the foundry business's performance in the quarter you're reporting here, actually a bit better than last quarter. But taking a step back on foundry and the whole fab construction project, we've been talking about CHIPS Act and whatnot. The Republican candidate for president, Donald Trump, former president, was talking to Joe Rogan a few days ago and was not very complimentary of the CHIPS Act, calling it a waste of money, that tariffs would get the job done better of shifting incentive to produce chips in the United States. Will tariffs help produce more chips in the United States?
Well, overall, I'd say, first, the CHIPS Act was a bipartisan act. And both Republicans and Democrats had strong support for it. We continue to see strong support from both sides of the aisle. I'd also say it included both grants, which we're frustrated that hasn't moved faster, and they've been too bureaucratic on that process. We're anxious to see those finished. But the other side of the CHIPS Act was the tax incentives, which we do expect have a meaningful impact. In fact, about 2 to 3 times larger than the grant side of CHIPS Act. In addition to that, as the candidates are talking about their future policy initiatives, hard to say, how those would affect the overall market. But I think the emphasis of the semiconductor industry, the critical role that it plays and Intel plays in bringing that back and reshoring that onto U.S. soils. We're anxious for whoever wins the election to be reinforcing the importance of that. We did a lot to get CHIPS Act done. We want to see that finished, and we're looking.
Okay, so didn't answer too much about the tariffs question, which is fair. I mean, if I was a CEO, I wouldn't answer that question either. You kind of got to dodge that one. But one thing that is very important that all of us can agree with is that we do need more chips made in America, because if anything happens in Taiwan, that's not going to be a good thing for the world, and definitely not for the United States. So there is an argument that the government should be helping Intel. The problem is it just feels weird, dude. They're firing 17,000 people today. They're announcing they fired basically 20,000 people 6 weeks ago. So you got 30,000 people laid off, but you collected, I think, 3.5 billion, a little bit more than that from the government, and they might get more with this CHIPS Act. So it's one of those things where it's weird. And look, maybe the firing doesn't have to do exactly with the money they got to build the factories. I get it. Like, those are two separate things. But in general, if there could be a way to not have to fire that many people while still investing in factories, then, that would be important. Now, again, they're looking out for shareholders as well. And what do shareholders want? They want lower costs, higher margins. The way to do that a lot of times ends up being to decrease labor. And so it's just a question of how Intel is going to navigate that, and also try to get more money from the government to build those factories. So that's what you got on Intel. Up 12%. Looks like it's going to stick. I don't think they say anything on the earnings call that could mess that up. Seems like it's going to be a good quarter for them. Now up 13%. Tomorrow morning maybe opens up closer to that 25, 26 range if the street can really start to feel there's a future for Intel. Amazon right here up 5.2%. I don't know if it breaks 200 tomorrow, but 196 is definitely closer to 200 than 186. It was down 4% in the last 10 minutes of the trading day. So if anyone bought the dip at 186, they are up right now. And then you got Apple that is up slightly after hours. We have a minute left until we get the results. So now we wait for Apple. And we're going to see what Apple can say in these results. By the way, money market funds are out. Money market funds is a nothing burger. They decreased by $2 billion. We still have $6.5 trillion on the sidelines. Last week, they increased by $40 billion. This week, they decreased by $2 billion. So nothing too big from the money market side. All right, here we go. We're waiting for Apple. Now we are waiting. We are up slightly after hours. I don't have the numbers yet. We're still looking for the numbers. I will let you know as soon as I can see these numbers on Apple. Still no numbers yet. Still no numbers yet. They should be coming any second. Oh, I think we got them. No, I think this one is not the right one. Again, the street's expecting 95 billion. And I think $1.60 of EPS. So now we are waiting for Apple. Oh, we're down. We're down on Apple. Is this a head fake or is this real? Now we're green. Now we're up. Now we're down. Now we're down. Now it's flat. Now it's down. 0.3, 0.4, up 0.4, down 0.7. Now it's down. Now we're down. Now we're down. Now we're down. Now it's green. Now, no, it seems like it's down. I think it'll be down. I think we're down. Let me see if I can get the numbers. I think we're down. Yep, now we're down. We see 97 cents. What? Is this the right number? No. Okay. 94.9 billion versus 94.5. Now we're up. So that's a beat. And 164 EPS versus 160. That's a beat by 4 cents. Beats on the EPS, beats on the revenue. Beats on the EPS, beats on the revenue. Not big beats, but they are indeed beats. Does the street care at all? The street does not really care. It's flat after hours. 0.04%. It is flat. Now we're going up a little bit. Now we're up 1%. Okay, now we got some movement. Now we got some green. Now we have some green. 229 on Apple. Until Apple goes above 235, we saw those numbers on Monday, so it's nothing that crazy, but seeing good green would be good. Up about 1%. So it was down for a good, I would say 45 seconds. Then it went flat. Now it went up. Now it went right back down again. Now it's down 0.5%. Apple's being very emotional right here. This is what happens when you don't have enough potassium, and that's why I like bananas. But Apple right here down about 1.3%. Let's see if we can get some real numbers, and we can get iPad, iPhone updates. Let's see if I can pull this up. And let's see if we can get it. I think we have the actual Apple. Do we have Apple right here? Let's see. Is it out? Is it out? No, not yet. Okay, so we're still waiting for Apple. Oh no, here it is. All right, here we go. We got Apple. Here we go.
Hey there, John. Yeah, and it's beats on the top and bottom lines here for Apple. EPS coming in at $1.64 on an adjusted basis versus estimates of $1.60. There's a one-time charge happening here for an EU tax bill that accounts for that adjusted number that we're using for comparisons here. Revenue was also a beat, $94.93 billion. Street was looking for $94.5 billion. And iPhone revenue was also a beat, $46.22 billion versus the $45.47 billion expected. And by the way, that is a record September quarter for iPhone revenue. And one miss in here, though, services was a miss on expectations, $24.97 billion versus $25.28 billion expected. We see shares pretty much flat here, John.
Okay, Brenda, sorry I had to cut you off there, but you understand. Angela, let me get to you on this. The stock is...
We'll listen to this, and I'll get some more numbers on Apple. I'm compiling some of their segment data, and then we'll take a look at that.
Is fractionally moving around right now. We'll see where it settles out. Of course, there's more to learn on the call, but this is a record iPhone quarter at a time when people were curious how this would go.
Yeah, no, you're absolutely right. And you kind of look at the iPhone here over the last two cycles. Essentially, it's been kind of no growth for the iPhone 15 and iPhone 14 cycle, called like no growth to low single-digit growth. So you kind of look ahead here going into the December quarter. Clearly, what's most important is going to be kind of what the guidance is looking for. But kind of, the first 10 days, at least.
Okay, so I'm not sure if Apple's going to give guidance for Q4. I don't know if they really do give guidance in general, but we'll see what they say on the call. So here's what we got for Apple. EPS of 164, revenue of 94. iPhone was 46.2 versus 45 expected. Mac was 7.7 versus 7.8, so they missed on the Mac. iPad was 6.9 versus 7.0, slight miss on the iPad. Other products was 9.04 versus 9.2, miss on that. Services they missed. Gross margins they slightly beat. So the only thing they beat on outside of the gross margins were iPhone revenues. And I guess that's what saved the quarter, as they're up 6% right here. They missed on Mac. They missed on iPad. They missed on other products. That's like your watches, your Air Maxes, the AirPods, all that stuff. You missed on services, and gross margins are up 0.2%. Literally, it's this looking like $600 million beat on the iPhone revenue, which is still the majority of their numbers. Okay, so where's the street having Apple right here after that? That's not, yeah, Apple's down 1.4. Yeah, that makes sense. I don't want to say this was a bad quarter, but I mean, there's nothing exciting about this quarter. They're growing 6%. You're paying a 34 PE for Apple. It's tough. It's not easy to justify that. It's really tough. And no number, like missing on services is weird, dude. Services is the part of the business that they keep touting to the street as like the most, profitable part of the business. They have this big install base, all this stuff. But a miss on services means that that's not scaling at least as much as they thought they potentially would be able to get that to scale. Let's get a little bit more coverage on Apple, and then we'll keep going. And then we'll go back to Amazon and get deeper into those numbers.
Yeah, the sort of mega platforms. It actually, on a year-to-date basis, it's held up reasonably well. It, had this burst higher in June, the WWDC, the unveiling of the AI capabilities. It goes from like 195 to 225, and it more or less has been there for 6 months or thereabouts, or 4 months, let's say. And so it's hung in there, and it's interesting because it seems as if at least, directionally expectations had been beaten down for iPhone for the upgrade cycle in the last several weeks. So it feels like there's a little bit of a sigh of relief, at least on that product line. But it also is the case, it's a 30 times PE. It used to be a 15 times PE 5 years ago. The reason you pay up more, in my view, is it should be a less hit-driven business, a little more consistent. And services has mostly proven that out. But I do think it's a relatively demanding standard here in terms of where the valuation has gotten to.
All right, stock still bumping around, down fractionally. This is the moment I've been waiting for. Let's get back to Steve Kovac for more on Apple's results. Steve, do we know how it looks inventory-wise on iPhone 16 and mix-wise here?
Not quite, John, but I did get some color from CEO Tim Cook. I caught up with him just moments ago to talk about these results. First, let me talk about some Apple Intelligence momentum so far. Tim Cook was talking about upgrades to that new software update that hit back on Monday. Here's what he told me, quote, a really early stat, which is only 3 days worth of data, but users are adopting iOS 18.1 at twice the rate that they adopted 17.1 in the year ago quarter.
That means nothing. Everyone's upgrading because they want to see the new features. That's the 17.1 had no features. So that stat means absolutely nothing. I mean, people using a certain feature, if he gave stats on that, that would mean something. But just upgrading to 18.1, I don't think is exciting. I don't think the street should care about that because everyone's curious what the AI features they have are. And then they download it like I did, and you get summaries of your notifications. And that's not, it's not the most exciting. So that to me is not that big of a deal.
So now clearly he thinks that is an indication of what Apple Intelligence demand actually looks like. So I asked him if he's also tracking how many of these people who upgraded actually turned on Apple Intelligence. You have to go in the settings and do it. He told me that they are tracking those figures, but they are not disclosing. But I will add,
of course, they're not disclosing that because that's the only stuff that matters, right? Like, so this is a nothing burger. He's not getting any juice from Tim Cook on this.
He did kind of sound optimistic about that upgrade rate. And then I was talking about that mix of 15 and 16. Keep in mind, this was a record quarter for iPhone sales. So I asked him how much of that is the 15 versus 16. He told me, quote, it's a combination that 15 was stronger than 14 in the year and 16 was stronger than 15. And later told me, plus keep in mind that the 15 Pro and Pro Max also run Apple Intelligence. So
I don't even know what that quote means, dude. It's a combination that 15 was stronger than 14 in the year, and 16 was stronger than 15, and 17 is bigger than 16, and 18 is bigger than 17. Like, what is dude, why can't they just tell us the amount of phones they sold, dude? This should, like, Warren Buffett should have made this a thing in the Apple shareholder meetings like years ago and be like, you have to disclose how many freaking phones you're actually selling, because this is getting ridiculous.
Slowdown of the prior generation in anticipation of the next, but that may not have happened in this case there, John, because of Apple Intelligence.
To clarify, Steve, was he saying that the mix in this quarter of 16s versus 15s was stronger than the mix of 15s versus...
Look, he doesn't even get it. Even the host is like, wait, what? What is he talking about?
Versus 14s in the quarter a year ago.
Correct.
Okay.
That's correct.
Steve Kovac, thank you. Brent.
You see how he said correct, and he's like, okay, that's okay. Let's move on, because I'm not even going to try to clarify what that actually means, because he doesn't know what he's talking about. Look, I'm being facetious here, but at the end of the day, it's not a good look, but it's Apple. Apple's not going to disclose anything because they're a $3 trillion company, and it's their world. We're living in it. And they know people are going to buy this stock through hell and high water. They know passive index funds are always going to allocate capital via their ETFs into Apple. So it is what it is, but Apple right here down about 1.4%. The way we know they're selling a ton of iPhone 16s in the future is if we see iPhone growth like lead the entire company into that double-digit revenue growth. And we're not there. We're at 6% revenue growth. It's, the iPhone's the only thing that's leading, but the iPhone's not leading enough to get us into 10, 15%, which, AI intelligence is supposed to do for Apple, but I don't know if that's going to happen anytime soon. So that's what we got right now in the context of Apple. We have the Amazon call in 20 minutes, folks. We'll be listening to Amazon. Apple also will be talking at 5 p.m., but I think it's worth listening to Amazon because Apple's calls, I listened to them in the past. They tend to be a little boring. Again, they don't really disclose anything, just like you saw in that CNBC clip. Amazon, Andy Jassy is just a rock star. He tends to actually answer questions and give some macro level vision that he has for the company. So I think that'll be a good one to listen to. 194 on Amazon, up about 4.4%. Fubo apparently had earnings as well. Fubo is up 5.2% or 4.6%. I'll see if I can pull up those numbers. And then Intel is up 9%. It was up 13. Now it's up 9%. So Intel taking a little bit of a 4% hit from being up 13%. Apple's down 2% on what they did to the Photos app. I agree, dude. I opened up Photos the other day and I was so confused. I was like, I was trying to just find my photos and they have all these random things. And I was like, this is that. Honestly, dude, I've said this a while ago. I don't care about AI. Just give me a battery that doesn't die. You give me a battery that doesn't die or that lasts for a week, I'll pay upwards of $2,000 for that phone. And I'm serious about it because I get so annoyed when my iPhone runs out of battery. I would give up all the AI in the world to have a good battery. But like those real fundamental technological breakthroughs, they haven't happened. And look, I don't blame Apple for that. It's hard to keep innovating on something that's already so good. But if that's the case, you got to give a little bit more of a dividend. You got to increase the buybacks even more. You got to do something to create shareholder value if it's not innovation in the context of your products. Look at Bitcoin. Bitcoin is $44 away from touching 69. It already touched 69 at 410. I didn't see that. Then it got right back to 70. Now it's barely hanging on to 70,000. This is not good for the crypto stocks. MicroStrategy somehow is up after hours because Michael Saylor controls the world. Hood is probably getting a hit on this. Hood is up a little bit after hours as well. Okay, so I guess Hood got most of its punishment during the day. And then Coinbase is up. Interesting. So Bitcoin's down almost below 70, and all the crypto stocks, at least Robinhood, Coinbase, and MicroStrategy are up. What about the miners? CleanSpark is also green. Huh. That's interesting. All the crypto stocks after hours are having some green, even though Bitcoin's down. I guess they're not believing that Bitcoin's going to keep falling from that 70,000 level onwards, which is why Street's buying up some of those stocks in anticipation for Bitcoin to rebound. There's Bitcoin right there below 70,000, 69,994. We would have to really, chill in the 60s for, I guess, the market to kind of think that we're back down from the 70s. But sentiment was different on Tuesday when we hit 73.5. We were $200 away from all-time highs on Bitcoin, and now we are $3,000 away from Bitcoin. Sonny says, bro, better battery is called Samsung Galaxy. So the thing is, I'm not an Android guy. I've always used iPhone. I'm never not going to use iPhone. It's, and that's one of the reasons why people buy Apple stock, because no one's ever leaving their products when you're hooked in. But I wouldn't leave Apple for Android just for the battery life. Like that's just, dude, I've had an iPhone since 2010. It's been 14 years. At this point, it's like not going to be easy to use an Android. But if Apple could increase batteries, that would be amazing. Anovix is working on batteries. They are a battery company. From my understanding, their batteries are for the headsets, which no one cares about because the Vision Pro is not really a thing anymore. But if they could create batteries for the actual phones, that would be nice. Palantir is flat after hours. S&P ended the day at 568, ended 2%. This is the first 2% down day for the S&P, I think, since September 6th. I think since September 6th, we haven't had a proper 2% day down. So first down day in a while. On the S&P 500. SMCI down about another 1.48% on the day. Now down close to 47% for the past 2 days. Nvidia up a little bit after hours. SoFi as well, down a little bit. Roblox had a great day, up about 20%. And Amazon is still chilling here at up 4.2% right now on the day. You should use 2 iPhones. It would make revenues double. Yeah, that would be funny. I just... It's just one of those things, dude, where Apple's really got to give people a reason to care. And as of now, I don't think they have it yet. AirPods are the best invention of the last 5 years by Apple. I agree. AirPods are, look, I love AirPods. I think they actually solve a problem, which is like wireless headphones. I know there's a lot of other wireless headphones, but if you're in the Apple ecosystem and you just, turn them on or you just put them in your ear and they immediately sync, it's always been an enjoyable experience. But it's not the future for Apple. The problem is with Apple as well, they're not really, there's not a visionary leader kind of explaining what the future is. So on the Vision Pro, I remember 2 quarters ago when they asked Tim Cook on the earnings call about the Vision Pro, he didn't have an answer on what the future is for the Vision Pro. And he kind of knew it was a botched release. It was a botched product. 3,500 made no sense. And there was just no actual conception of what it would be like. If they don't have that next game-changing product, which it's okay if they don't, but they have to be transparent about it, then what are you buying Apple for, right? That's the question. Outside of the iPhone 17, which maybe has even better AI features, which it could, but I think right now that's something the street's going to have to really struggle with to figure out why they like Apple or not. All right, we've got the call in 15 minutes from Amazon, and we're going to see what Mr. Jassy has to say. Let's get some coverage on Apple as well, and then we will keep going from there. Thomas says they need to acquire the home, make appliance companies, Peloton and Leviton, and make everything in home an Apple product. I did say they should acquire Peloton a while ago. And maybe it's a stupid idea, but just something to have more organic growth, because as of now, outside of the iPhone, there just really isn't any growth.
Nest Labs co-founder Tony Fadell. He's part of the team that created the iPod and co-creator of the iPhone as well. Tony, great to have you back. So there've been lots of questions about Apple's staying power here, but it seems to me like they delivered a record iPhone quarter in the services business. Even though that line was a little weaker than expected, that seems to sort of follow phone sales more than anything.
Absolutely. You know, look at the numbers. They just had a consistent, growth, not high growth, but consistent growth. And it's just continuing on the services numbers. As you say, it kind of delayed, the services numbers are delayed by a few months after people use their new devices and then sign up. So nothing much to see here except another great quarter for Apple.
What's your expectation for how something like Apple Intelligence ramps and how the whole AI strategy ramps? Right now, it seems to me like this is just the infancy of it, because so often what Apple tries to do is use its vertically integrated strategy to make it a platform of choice for developers to be able to do things that they can't do on other platforms. Right now, we're talking about what Apple is doing in its own apps with AI more than we're talking about the impact on the ecosystem, right?
You're absolutely right. This is all about a platform play. They have a very modest initial offering that came out this week with iOS 18.1. It's just the Apple apps, but the APIs have now been distributed to all the developers. So now what we're going to see is what's going to happen over time, over the next 6-9 months, as the developers swarm in and start using these APIs and the next generation ones that are coming just in the winter and the spring. So this is very unlike Samsung and all the other competitors in the Android world, because they don't have the same API/AI hardware across the phone. So developers can't take advantage of AI at the edge or on the device itself, because they just don't have that kind of infrastructure, Android and the hardware that doesn't support it. So Apple has a very big leg up on AI at the edge versus anyone else out there.
So what's also going to be important, guys, is Berkshire reports earnings on Saturday. We're going to find out if Buffett sold more Apple. He already decreased 50% of the position. If he decreased even more, then I think the street's going to have a reaction to that. So we will find out on Saturday around 8 a.m. how much Apple Buffett still holds, and if that matters to the street.
So help investors dream here, right? Because they got to really think forward to summer of 2025, WWDC, what kinds of developer tools and capabilities and features might get rolled out to have an idea of what Apple might be able to do here that's different. But games are such an important part of the iOS platform. With AI tools, what can you build that's different than what you could have built before?
Well, I think you can see much more rich experiences. With AI, you can actually have these what's called NPC, non-playable characters, where you can have very rich experiences with these non-playable characters that are literally AI-driven. They're like mini humans or mini agents. We're seeing that with companies like Character AI and some of the stuff in ChatGPT, where you think you're actually talking to a person. So you can bring these new things to light in games and other entertainment, as well as educational experiences.
So comparing what Apple tends to do even on the client side with the capabilities that so many of the hyperscalers are building out in the cloud, Alphabet's, Google, we're just talking about Amazon, AWS, which just reported that stock was higher, Microsoft as well. What's the difference between how investors should think about AI capabilities in the cloud versus what happens when they're on the device?
So first of all, you're going to have a much richer set of applications and things you can do with these huge models in the cloud. But those huge models in the cloud are not profitable, okay? Nobody's making any money. Everyone's still building out data centers and everything. Whereas Apple, when it's on device, and only on the devices that are AI aware, of course, and now they've also introduced all the things on the Mac side just this week that's going to take advantage of that. You're going to see all of those things being run maybe to a lesser capability as the ones in the cloud, but on device, and you're going to get there, and they're going to be cheap and fast and private. So it's going to be a very, very different model than what's in the cloud and what we're seeing today. But it's going to be powerful because it's going to be across the entire Apple ecosystem, as well as all the apps that can take advantage of them. So you can still use ChatGPT and these things in the cloud, but you're going to get on-device access through Apple's APIs and third-party apps.
So quickly, what are you excited about building with this?
What am I excited? I think about the next generation smart home. So we've been talking about smart home, like, oh, you can make security, like a real security agent in the cloud or on your device that can watch all your cameras. Let's say an Apple TV that watches all your cameras and can tell you this person came home, left this time, the dog's doing this, something's going on in the kitchen. These things can all be done right inside the
So Airbnbs will get creepier, is what I'm hearing from that.
home, and AI can watch it like a AI security guard.
All right. Tony Fadell, always great to have you, especially on a day like this with Apple earnings.
Thanks so much, Sean.
Up next, much more.
All right. Look, I think the stuff he said was not wrong right there, but it is, again, something that Apple's got to sell to the street as something. Like, nothing he said right there was exciting. And unfortunately, I think until the street gets excited, we're going to see some issues with the Apple narrative to get there. Shyam Sankar's on Yahoo. Is he right now? Is Shyam Sankar on Yahoo? That would be nice to watch. We got 8 minutes until the call comes out. Let me see if I can find that. I think he is. Okay, let's give it a second. Let's see if it pulls up. And then we'll see what he has to say. Also, yeah, I agree with Krupa right here. Talking about the smart home does feel like Apple's a bit behind. Remember Apple was talking about building those robots for the home? I don't know if that idea is still around, but that is something they were thinking about. But like, again, it just feels like these things are kind of late in terms of what they're doing. All right, we do have Shyam Sankar on CNBC. We do. Here we go. CTO Palantir, Mr. Shyam Sankar is on, sorry, not CNBC, Yahoo Finance. Let's hear what he has to say, and then we will be getting into the Amazon call at 5 p.m.
Acknowledging that we're in this state of undeclared emergency. You know, we have North Korea firing off ballistic missiles, North Korean soldiers now in the front with Ukraine. We've had a pogrom in Israel. We have the Russians providing targeting information to the Houthis to hold 15% of world trade hostage. You know, what more would we have to see to actually kind of mobilize now? And so looking at that, you know, we have a couple weeks of weapons on hand for the China fight. We see that Ukraine expended 10 years of production in 10 weeks. And so are we ready? Are we doing everything? And when I look back at our history, how did we win World War II? How did we win the Cold War? We didn't have a defense industrial base. We had an American industrial base. 94% of spending on major weapon systems did not go to defense companies. It went to dual purpose companies. Chrysler made, in my lifetime, Chrysler made cars and missiles. Ford made satellites until 1990. General Mills, the cereal company, made artillery. The very laydown of our economy was so different. Every car, camera, and cereal box you bought enhanced our national security. And unfortunately, that's what China's doing to us. Only 30% of their defense company revenue even comes from the PLA. The rest comes from us buying cheap knickknacks on Amazon.
So is the way to fix this? Is it reimagining incentives, Shyam? How do we fix it?
I think so. I think the talk track since the end of the Cold War is really that we consolidate our industrial base. We don't have enough competition amongst the industrial base. That may be true, certainly not my lived experience. I think the real problem is we gave up on competition within government. When we were building the ICBM program, it was the Navy, the Army, and the Air Force competing against each other to make the very best product. When we were building the submarine-launched ballistic missiles, we had 4 competing programs inside the Navy itself. Today, we would find that wasteful, duplicative. We grant these monopolies, which actually, if you really step back and squint at it, that looks like central planning and communism. We're saying there's just one approved way of doing this. And I think at a deep fundamental level, we believe in competition as a country. We believe in the innovation that comes from the free market. And what excites me, like what catalyzed me to really write this right now, is that the founders are back. I think the consequence of the Defense Last Supper in 1993, where we started this consolidation, is that we drove the innovators and the entrepreneurs out of the sector.
Which is such a big part of American defense history, those historic mavericks, innovators, right?
Exactly. Yeah. Like we think about it today as Northrop Grumman, but it was Leroy Grumman and Jack Northrop. It wasn't Northrop Grumman. It wasn't the institution. It was these people. It's folks like Palmer Luckey and Elon Musk. It is folks like Alex Karp. This is how we're going to resurrect the American industrial base.
So we have an election. Do you look at the candidates, Shyam, and say one more than the other, Trump or Harris, it would be more open to reimagining the DoD in the way that you're kind of suggesting here?
Well, I think broadly, both sides, this is very much a bipartisan issue. People see the problems that we're facing here, but it really starts with leadership, which is, I think, maybe not something you'd expect a technologist to say. I don't think technology is going to magically save us here. When Admiral Rickover was building the nuclear Navy, he was in that seat for 30 years. John Boyd was the father of the F-16. Who's the father of the F-35, the $2 trillion F-35 with 30% availability? It was designed by committee. It's run by committee. It's been 3 decades in design and development. There's a mechanism that was really working. And I think having become the world's superpower, we kind of turned our back on all the mechanisms that we actually use to win. And so we have a very clear blueprint that's actually based on our past. But I think one thing that's very clear is that we have to reindustrialize. And as a country, we have to reimagine how we're going to industrialize. And I see that, half of our business is about helping companies build cars, planes, trains, ships, bending atoms better with bits. And to do this, we have to give American workers superpowers. We can't compete symmetrically with China. At the dawn of World War II, we were the best at mass production. Today, our adversary is. So what is David's slingshot in doing this? Well, we are the world's best by a yawning margin at software. And so we have to use our AI advantage to bring automation and let's call it an Iron Man suit for American workers.
Is it sort of like bringing a Tesla manufacturing blueprint to
Exactly.
defense?
Tesla, SpaceX. I mean, we've been working with Panasonic Energy to make every battery in the Tesla Gigafactory in Reno, and they are giving their workers super. They're not using exquisite Japanese engineers. They're making every American as effective as an exquisite Japanese engineer.
I mentioned Trump and Harris, and my question about that, Shyam, is, listen, neither candidate wants to address this country's fiscal challenges, which are serious. Bill could come due. At some point, you actually might have to get spending under control. Any concern that at some point there may be a haircut to defense spending and how that could ripple affect, Palantir and others?
Well, I don't think this is a spending problem. I think we are spending. We have plenty of money to go after this. It's how we're spending it that we need to really look at. I would say that with the caveat that we are actually spending at historic lows. We are spending, I think, roughly 2.7% of GDP. If we look back at what is the cost of ensuring our national security, which exists as a means of underwriting our economic prosperity and individual liberties, it is at a historic low. So I'm not saying it needs to go up. I'm just saying it would be good for because we see this big flagship number and it seems scary, but we have to actually understand it's relatively small.
Relative to GDP.
Yes.
Right. Let me ask you, I saw this interesting article, you saw it too in the Journal, this new DoD initiative. And the whole idea here, let's recruit top tech talent to join the reserves. You're part of that, it sounds like. Walk me through what's going on there, Shyam.
Well, I'd say in the past, we had a much closer relationship there between the civil and military sectors. When George Marshall was putting together the Marshall Plan, he really called up all of his friends who were the captains of industry. He had good advice around him. What I see and what I really learned from the early days of the Israel conflict, when they mobilized 360,000 reservists, when they went back into the IDF, they were horrified at the state of technology. And that is an exceptionally technical country. So that is an implicit self-critique saying, wow, now that I'm 20 years more experienced than I was when I was a conscript, I've learned so much from industry. I've built these internet scale applications. I would do this differently. They modernized more in the 4 months afterwards than in the 10 years prior. And so we have this natural resource in this country in spades, not just in the software field, but in hardware manufacturing and in industrials and power. How do we bring that talent base? There is a people industrial base aspect of this and creating more fluidity for people to be able to serve in these capacities.
Did you think it sort of reflects this broader trend or shift? I mean, of technologists, tech entrepreneurs wanting to and embracing the U.S. military, wanting to work with the military? Is that a shift?
That is a I've been doing this for 20 years, and I'd say it's a.
It wasn't always like
shift.
that, right?
It was the opposite of that, and I think that it's very clear now that people want to serve. They're not taking this for granted anymore. It is a sea change from what it was a decade.
Why is that, Shyam? What did change?
I think the world changed around us. Like there was a fair amount of, if you were going to psychoanalyze it, self-loathing in the country of what is going on here. But we see what's happening in Ukraine. We recognize that, just because we were the global superpower, maybe the end of history didn't really happen. And everything that we're able to do as technologists, the economic freedom that we have, is earned. It's not a birthright.
Let me ask you, I want to get you out of this, Shyam. So earnings are coming up. I know you got to be careful. I am interested, though, as you look ahead now, 2024, your stock has roared, right? As you look to 2025, what's next for Palantir? What excites you?
What really excites me is the continued adoption of AI across the U.S. commercial sector in particular, where people are rolling up their sleeves and getting busy implementing it. And what I see as a broad theme is you can kind of think of AI as there's two parts of it. There's the AI supply, the model side, and people are investing a lot in building these models. But if you take a step back and look at it, while the models are improving, both the closed models and the open models are getting more similar. So they're getting smarter, but more similar to each other. And if you look at the demand side, we've been uniquely positioned. This technology that we call the ontology, which with other people are starting to notice now, is a prerequisite to being able to harness AI for economic value in the enterprise.
All right, Amazon is starting. That was Shyam Sankar on CNBC or Yahoo Finance. And now we're getting into Amazon.
Today to answer your questions is Andy Jassy, our CEO, and Brian Osofsky, our CFO. As you listen to today's conference call, We encourage you to have our press release in front of you, which includes our financial results as well as metrics and commentary on the quarter. Please note, unless otherwise stated, all comparisons in this call will be against our results for the comparable period of 2023. Our comments and responses to your questions reflect management's views as of today, October 31st, 2024 only, and will include forward-looking statements. Actual results may differ materially. Additional information about factors that could potentially impact our financial results is included in today's press release and our filings with the SEC, including our most recent annual report on Form 10-K and subsequent filings. During this call, we may discuss certain non-GAAP financial measures. In our press release, slides accompanying this webcast, and our filings with the SEC, each of which is posted on our IR website, you will find additional disclosures regarding these non-GAAP measures, including reconciliations of these measures with comparable GAAP measures. Our guidance incorporates the order trends that we've seen to date and what we believe today to be appropriate assumptions. Our results are inherently unpredictable and may be materially affected by many factors, including fluctuations in foreign exchange rates, changes in global economic and geopolitical conditions and customer demand and spending, including the impact of recessionary fears, inflation, interest rates, regional labor market constraints, world events, the rate of growth of the internet, online commerce, cloud services, and new and emerging technologies, and the various factors detailed in our filings with the SEC. Our guidance assumes, among other things, that we don't conclude any additional business acquisitions, restructurings, or legal settlements. It's not possible to accurately predict demand for our goods and services, and therefore our actual results could differ materially from our guidance. And now, I'll turn the call over to Andy.
Thanks, Dave. Today we're reporting $158.9 billion in revenue, up 11% year over year, excluding the impact from foreign exchange rates. Operating income was $17.4 billion, up 56% year over year, and trailing 12-month free cash flow adjusted for equipment finance leases was $46.1 billion, up 128% or $25.9 billion year over year. As always, we're focused on making our customers' lives better and easier and thinking long-term with respect to how we can keep helping customers and build a successful business that outlasts all of us. In our stores business, we saw sales growth of 9% year over year in the North America segment and 12% year over year in the international segment. Our team continues to focus on the inputs that matter most to customers: really broad selection, low prices, fast and free delivery, and a range of compelling Prime member benefits, including our recent additions of unlimited grocery delivery from Whole Foods Market, Amazon Fresh, and local third-party grocery partners for $9.99 a month, and fuel savings of 10 cents a gallon at BP, Amoco, and AMPM stations in the U.S. At a time when consumers are being careful about how much they spend, we're continuing to lower prices and ship even more quickly, and we can see this resonating with customers as our unit growth continues to be strong and outpace even our revenue growth. In the last few months, we've hosted our largest and most successful Prime Day and Prime Big Deal Days ever and helped customers save over $5 billion across more than 50 million deals. And for the second year in a row, we are on track to deliver at our fastest speeds ever for Prime members globally. We also continue to focus on lowering our cost to serve and are pursuing several initiatives that we believe will have meaningful long-term impact in this area. First, we continue to believe there are more gains on top of what we've captured thus far in outbound regionalization and getting more items closer to end consumers. As such, we're in the process of significantly changing the way we inbound items into our fulfillment network and subsequently spread them to our regional fulfillment nodes. In the last few months, we've made hundreds of changes to our U.S. inbound network and opened more than 15 inbound buildings. While it's still relatively early in this re-architecture, we've already improved our ability to spread inventory across our fulfillment centers by 25% year over year, allowing us to have more of the requisite items in fulfillment centers closest to the customer so we can compile shipments and ship to customers even more quickly. As we scale and optimize this new design, we expect these changes will further improve inventory placement, offer faster delivery times, save transportation costs, and enable us to increase units shipped per box. Second, we continue to roll out same-day delivery facilities, which is not only the fastest way to get products to customers, but also one of our lowest-cost ways to deliver. Over 40 million customers this past quarter have had their orders delivered for free with same-day delivery, an increase of more than 25% year over year. And third, we continue to innovate in robotics to speed delivery, lower cost to serve, and further improve safety in our fulfillment network. We recently launched our 12th generation fulfillment center design, with the first building launching in Shreveport, Louisiana. This is the first facility that incorporates our newest robotics inventions that simplify stowing, picking, packing, and shipping processes. Thus far, this new design reduces fulfillment processing time by up to 25%, increases the number of items we can offer for same-day or next-day delivery, and is expected to drive a 25% improvement in our cost to serve during peak within this next-generation facility. Though we believe we have more expansive automation and robotics than other retail peers, it's still early days in how much automation we expect in our fulfillment network. In advertising, we remain pleased with our progress, generating $14.3 billion of revenue in the quarter, 18.8% year-over-year growth. Our expansive reach, ability to surface relevant offers to our customers, opportunity to engage customers from the top of the funnel to point of purchase, and leading capabilities around measuring outcomes at every touch point provide all types of brands with full funnel advertising at scale. With sponsored products, we're seeing meaningful growth on a very large base, and we see further opportunity in driving even better performance for advertisers by further improving the relevancy of the ads we show and by providing additional optimization controls. At the same time, some of our newer offerings are in their very early days. We're just entering our first broadcast season for Prime Video advertising, following a very strong showing at Upfronts. And we're continuing to support brands of all sizes with our generative AI-powered creative tools across display, video, and audio, including our video generator that uses a single product image to curate custom AI-generated videos. While we're generating a lot of advertising revenue today, there remains considerable upside. AWS grew 19.1% year over year, and now stands at a $110 billion annualized run rate. We've seen significant re-acceleration of AWS growth for the last 4 quarters. With the broadest functionality, the strongest security and operational performance, and the deepest partner community, AWS continues to be customers' partner of choice. There are signs of this in every part of AWS's business. We see more enterprises growing their footprint in the cloud, evidenced in part by recent customer deals with the ANZ Banking Group, Booking.com, Capital One, Fast Retailing, Itaú Unibanco, National Australia Bank, Sony, T-Mobile, and Toyota. You can look at our partnership with NVIDIA called Project Siba, where NVIDIA has chosen AWS's infrastructure for its R&D supercomputer, due in part to AWS's leading operational performance and security. And you can see how AWS continues to innovate in its infrastructure capabilities with deliveries like Aurora Limitless Database, which extends AWS's very successful relational database to support millions of database writes per second and manage petabytes of data while maintaining the simplicity of operating a single database. Or with our custom Graviton 4 CPU instances, which provide up to nearly 40% better price performance versus other leading x86 processors. Companies are focused on new efforts again, spending energy on modernizing their infrastructure from on-premises to the cloud. This modernization enables companies to save money, innovate more quickly, and get more productivity from their scarce engineering resources. However, it also allows them to organize their data in the right architecture and environment to do generative AI at scale. It's much harder to be successful and competitive in generative AI if your data is not in the cloud. The AWS team continues to make rapid progress in delivering AI capabilities for customers and building a substantial AI business. In the last 18 months, AWS has released nearly twice as many machine learning and Gen AI features as the other leading cloud providers combined. AWS's AI business is a multi-billion-dollar revenue run rate business that continues to grow at a triple-digit year-over-year percentage and is growing more than 3 times faster at this stage of its evolution as AWS itself grew. And we felt like AWS grew pretty quickly. We talk about our AI offering as 3 macro layers of the stack, with each layer being a giant opportunity, and each is progressing rapidly. At the bottom layer, which is for model builders, we were the first major cloud provider to offer NVIDIA's H200 GPUs through our EC2 P5e instances. And thanks to our networking innovations like Elastic Fabric Adapter and Nitro, we continue to offer advantaged networking performance. And while we have a deep partnership with NVIDIA, we've also heard from customers that they want better price performance on their AI workloads. As customers approach higher scale in their implementations, they realize quickly that AI can get costly. It's why we've invested in our own custom silicon in Trainium for training and Inferentia for inference. The second version of Trainium, Trainium 2, is starting to ramp up the next few weeks and will be very compelling for customers on price performance. We're seeing significant interest in these chips, and we've gone back to our manufacturing partners multiple times to produce much more than we'd originally planned. We also continue to see increasingly more model builders standardize on Amazon SageMaker, our service that makes it much easier to manage your AI data, build models, experiment, and deploy to production. This team continues to add features at a rapid clip, punctuated by SageMaker's unique HyperPod capability, which automatically splits training workloads across more than 1,000 AI accelerators, prevents interruptions by periodically saving checkpoints and automatically repairing faulty instances from their last saved checkpoint, and saving training time by up to 40%. At the middle layer, where teams want to leverage an existing foundation model customized with their data, and then have features to deploy high-quality generative AI applications, Amazon Bedrock has the broadest selection of leading foundation models and most compelling modules for key capabilities like model evaluation, guardrails, RAG, and agents. Recently, we've added Anthropic's Claude 3.5 Sonnet model, Meta's Llama 3.2 models, Mistral's Large 2 models, and multiple stability AI models. We also continue to see teams use multiple model types from different model providers and multiple model sizes in the same application. There's muck and orchestration required to make this happen, and part of what makes Bedrock so appealing to customers and why it has so much traction is that Bedrock makes this much easier. Customers have many other requests, access to even more models, making prompt management easier, further optimizing inference costs, and our Bedrock team is hard at work making this happen. At the application or top layer, we're continuing to see strong adoption of Amazon Q, the most capable generative AI-powered assistant for software development and to leverage your own data. Q has the highest reported code acceptance rates in the industry for multi-line code suggestions. The team has added all sorts of capabilities in the last few months, but the very practical use case recently shared, where Q Transform saved Amazon's teams $260 million and 4,500 developer years in migrating over 30,000 applications to new versions of the Java JDK, has excited developers and prompted them to ask how else we could help them with tedious and painful transformations. Spend a few minutes reading developer forums about what they wish they could move away from, and you'll get an idea of what they want. Expect more practical AI game changers from Q. We're also using generative AI pervasively across Amazon's other businesses, with hundreds of apps in development or launched. For consumers, we've expanded Rufus, our generative AI-powered expert shopping assistant, to the UK, India, Germany, France, Italy, Spain, and Canada. And in the US, we've added more personalization, the ability to better narrow customer intent, and real-time pricing and deal information. We've recently debuted AI shopping guides for consumers, which simplifies product research by using generative AI to pair key factors to consider in a product category with Amazon's wide selection, making it easier for customers to find the right product for their needs. For sellers, we've recently launched Project Amelia, an AI assistant that offers tailored business insights to boost productivity and drive seller growth. We continue to re-architect the brain of Alexa with a new set of foundation models that we'll share with customers in the near future. And we're increasingly adding more AI into all of our devices. Take the new Kindle Scribe we just announced. The note-taking experience is much more powerful with the new built-in AI-powered notebook, which enables you to quickly summarize pages of notes into concise bullets in a script font that can easily be shared. Speaking of Kindle products, we just launched a completely new Kindle lineup, the first time we've done a portfolio refresh of this size. Apart from the Scribe, it includes the first ever color Kindle, the fastest Kindle Paperwhite ever, and a new pocket-sized Kindle. The early sales for these devices have significantly outperformed our expectations, and Kindle is having an excellent year with customers reading more than ever. We now have over 20 billion average monthly pages read on Kindle devices worldwide. There are so many things we're energized by right now, but we'll quickly mention one more, the progress we're making in improving customers' pharmacy experience. Brick-and-mortar pharmacies account for just over 90% of prescriptions dispensed in the U.S., but require customers to make trips to forlorn physical venues with much of the selection behind locked shelves, wait in lines for meds, and only find out about pricing at the point of purchase. The largest mail order pharmacies offer deliver in 5 to 10 business days. We think customers deserve better. Today, we can deliver to 95% of first-time Amazon pharmacy customers in the U.S. within 2 business days, and to 20% of U.S. Prime members within 24 hours. Next year, we plan to launch operations in 20 new cities, so nearly half the U.S. will have the ability to have their medications delivered to their door within hours. We believe making it easier for customers to get their medications will improve medication adherence, which we know can directly improve health outcomes. Across Amazon, we have a lot coming in the next few months. We eagerly look forward to sharing these with customers, and a big thank you to my Amazon teammates around the world for all their hard work. And with that, I'll turn it over to Brian for a financial update.
Thanks, Andy. Let's start with our top-line financial results. Worldwide revenue was $158.9 billion, an 11% increase year over year, excluding a 20 basis point unfavorable impact of foreign exchange. As a reminder, our Q3 guidance had anticipated a larger unfavorable impact of approximately 90 basis points. Worldwide operating income increased 56% year over year to $17.4 billion, our highest quarterly operating income ever, and was $2.4 billion above the high end of our guidance range. We remain focused on streamlining and managing costs in a way that allows us to continue inventing for customers in a cost-effective way. In the third quarter, North America segment revenue was $95.5 billion, an increase of 9% year over year. International segment revenue was $35.9 billion, an increase of 12% year over year. Worldwide paid units accelerated to 12% growth year over year as our customers continue to come to Amazon for low prices, broad selection, and convenient, fast delivery. Prime remains a core contributor to this growth. Year-over-year paid membership growth accelerated in Q3 for both the U.S. and globally, helped by our 10th annual Prime Day event in mid-July. Customers are enjoying even faster delivery speeds, which also helps drive strong growth in items like everyday essentials. This includes items like health, beauty, and personal care, as well as non-perishable grocery. And while these items often have a lower average selling price, the strength in everyday essentials revenue is a positive indicator that customers are turning to us for more of their daily needs. We see that when customers purchase these types of items from us, they build bigger baskets, shop more frequently, and spend more on Amazon. We remain focused on keeping prices sharp and offering broad selection that gives customers options when making purchase decisions. Shifting to profitability, our North America and international segments each delivered their 7th consecutive quarter of year-over-year operating margin improvement. North America segment operating income was $5.7 billion, an increase of $1.4 billion year over year. North America operating margin was 5.9%, up 100 basis points year over year. In the third quarter, we continued to make progress in improving our fulfillment network cost structure, driven in part by improved inventory placement. This helped us drive better productivity in our transportation network and shipping efficiency from higher units per box. In the international segment, operating income was $1.3 billion, an improvement of $1.4 billion year over year. International operating margin was 3.6%, up 390 basis points year over year. So far this year, we've generated operating profit in each of the 3 quarters for the international segment and totals $2.5 billion year to date. We're seeing strength in our established countries like the UK and Germany as we continue to drive efficiencies to improved on-road productivity in our transportation network and better execution in our fulfillment centers. Our emerging countries are growing revenue at a healthy rate also, and they are leveraging their cost structures while investing strategically in Prime benefits. We have confidence that our focus on the inputs, coupled with the strength of our global teams, will continue to drive improvement over time. Advertising remains an important contributor to profitability in the North America and international segments. This quarter, we saw strong growth on an increasing large base of advertising revenue. We see many opportunities to further expand our ads offering in areas that are driving growth today, like sponsored products, as well as more recent growth areas like Prime Video ads. Moving next to our AWS segment, revenue was $27.5 billion, an increase of 19.1% year over year, excluding the impact of foreign exchange. AWS now has an annualized revenue run rate of $110 billion. The business continues to grow, and we see opportunity to expand our core cloud offering and our AI services. Customers increasingly recognize that to get the true benefit of generative AI, they also need to move to the cloud. AWS operating income was $10.4 billion, an increase of $3.5 billion year over year, and as a result of our continued focus on cost control, including a measured pace of hiring, a focus on driving efficiencies on our infrastructure, and reducing costs across the business. Additionally, we increased the estimated useful life of our servers starting in 2024, which contributed approximately 200 basis points to the AWS margin increase year over year in Q3. As we've said in the past, we expect the AWS operating margins to fluctuate, driven in part by the level of investments we're making at any point in time. Now turning to our capital investments. As a reminder, we define these as a combination of cash CapEx plus equipment finance leases. Year-to-date capital investments were $51.9 billion. We expect to spend approximately $75 billion in CapEx in 2024. The majority of the spend is to support the growing need for technology infrastructure. This primarily relates to AWS as we invest to support demand for our AI services, while also including technology infrastructure to support our North America and international segments. Additionally, we're continuing to invest in our fulfillment and transportation network to support the growth of the business, improve delivery speeds, and lower our cost to serve. This includes investments in same-day delivery facilities, in our inbound network, and as well in robotics and automation. We're encouraged by the start of the holiday season, which kicked off in October with a strong Prime Big Deal Days. We are ready to serve customers throughout the season, and I want to thank our teams across Amazon for delivering 2 very large Prime member events in the past 4 months, and for getting us ready to delight customers during this holiday season. With that, let's move on to your questions.
All right, here we go.
Thank you.
Q&A.
At this time, we will now open the call up for questions. We ask each caller to please limit yourself to 1 question. If you would like to ask a question, please press star 1 on your keypad. We ask that when you pose your question, you pick up your handset to provide optimum sound quality. Once again, to initiate a question, please press star, then 1 on your touchtone telephone at this time. Please hold while we poll for questions. Thank you. And the first question comes from the line of Doug Anmuth with JP Morgan. Please proceed with your question.
Thanks so much for taking the questions. Brian, I was hoping you could talk a little bit more about the drivers of the 38% AWS margins. I know you mentioned the 200 basis points related to the useful lives push out, but just how to think about sustainability, kind of in the 30s there going forward. And then perhaps related, the step up in CapEx that you saw in 3Q. You gave the full year number, which was helpful. Any kind of early read or thoughts on how we should think about 2025? Thanks so much.
Okay, thanks, Doug. Let me start with AWS. The primary drivers of the year-over-year margin increase are threefold. So first is accelerating top line demand. That helps with all of our efficiencies, our cost control efforts, and of course, what you just mentioned, I believe the change in the useful life of our servers this year. Let me remind you on that one. We made the change in 2024 to extend the useful life of our servers. This added about 200 basis points of margin year over year. On cost control, there's been a number of areas. It's first is hiring and staffing. We're being very measured in our hiring, and you can tell as a company where our office staff is down slightly year over year, and it's flat to the end of last year. So we're really working hard to maintain our efficiencies, not only in the Salesforce and other areas and production teams, but also in our infrastructure areas. Infrastructure is a big part of our cost structure in AWS, and we're probably the best at matching up supply and demand and driving cost efficiencies and driving those operations very strongly. I think you saw that this quarter, especially on the higher volume. Over time, this margin will fluctuate in the segment. There's a number of factors to keep in mind, including our level of investment and the amount of innovation and product development we're doing for new products and services, changes in our staffing for sales and support organizations, and of course, capital to support customer growth and to build cost performance chips for our customers' applications. So, and as I mentioned, we do a really good job of matching supply and demand. And when you do that in this business, it can result in quarters like we just saw.
Yeah, I'll take the CapEx part of that. As Brian said in his opening comments, we expect to spend about $75 billion in 2024. I suspect we'll spend more than that in 2025. And the majority of it is for AWS, and specifically the increased bumps here are really driven by generative AI. As I was mentioning in my own opening comments, our AI business is a multi-billion-dollar business that's growing triple-digit percentages year over year, and is growing 3 times faster at its stage of evolution than AWS did itself. And we thought AWS grew pretty fast. And so the thing to remember about the AWS business is the cash life cycle is such that the faster we grow demand, the faster we have to invest capital in data centers and networking gear and hardware. And of course, in the hardware of AI, the accelerators or the chips are more expensive than in the CPU hardware. And so we invest in all of that up front in advance of when we can monetize it with customers using the resources. But, of course, a lot of these assets are many-year useful life assets. Data centers, for instance, are useful assets for 20 to 30 years. And so I think we've proven over time that we can drive enough operating income and free cash flow to make this a very successful return on invested capital business. And we expect the same thing will happen here with generative AI. It is a really unusually large, maybe once in a lifetime type of opportunity. And I think our customers, the business, and our shareholders will feel good about this long term, that we're aggressively pursuing it.
And our next question comes from the line of Ross Sandler with Barclays. Please proceed with your question.
Andy, if I could push on that last answer, you talk about how AI is about the same size but growing way faster than early AWS. And if we look back, at the market in like the early 2010s, it was hyper competitive on pricing. Your margins were below 15%, I believe, back then. And it seems like a lot of that is what's going on right now in AI with these new AI data centers, where you got competitive pricing and suboptimal utilization just in the whole industry. So as that revenue line grows from where it is today to tens of billions of dollars in coming years, how does that margin come on from the AI data centers versus your existing kind of 30+% margin at AWS? Any thoughts on how quickly you can close the gap and how that looks on the new AI workloads versus maybe this mid-30s that the core business is running at? Thank you very much.
Yeah. So some quick context, Ross. I think one of the least understood parts about AWS over time is that it is a massive logistics challenge. If you think about, we have 35 or so regions around the world, which is an area of the world where we have multiple data centers, and then probably about 130 availability zones of data centers. And then we have thousands of SKUs we have to land in all those facilities. And if you land too little of them, you end up with shortages, which end up in outages for customers. So most don't end up with too little, they end up with too much. And if you end up with too much, the economics are woefully inefficient. And I think you can see from our economics that we've done a pretty good job over time at managing those types of logistics and capacity. And it's meant that we've had to develop very sophisticated models in anticipating how much capacity we need where in which SKUs and units. And so I think that the AI space is for sure earlier stage and more fluid and dynamic than our non-AI part of AWS. But it's also true that people aren't showing up for 30,000 chips, in a day. They're planning in advance. So we have very significant demand signals giving us an idea about how much we need. And I think that one of the differences, if you were able to get inside of the economics of the different types of providers here, is how well they manage that utilization and that capacity. It has a very direct impact on what kind of margins you have over time and what kind of capital efficiency you also have over time. And so I think you're right, Ross, that there are some similarities in the early days here of AI where the offerings are new and people are very excited about it. It's moving very quickly, and the margins are lower than what I think they will be over time. The same was true with AWS. If you looked at our margins around the time you were citing in 2010, they were pretty different than they are now. And I think as the market matures over time, they're going to be very healthy margins here in the generative AI space.
And the next question comes from the line of Brian Novak with Morgan Stanley. Please proceed with your question.
Thanks for taking my questions. Hey, Andy, I have two. The first one, I feel like we talk a lot about your targets and sort of North Stars for domestic profitability. Can you talk to us a little bit about how you think about the drivers of international retail profitability from here, and sort of how you think conceptually where the margins could go and what drives them there? And then the second one, I wanted to sort of ask you more about the robotics that you mentioned. I know you've been investing in robotics now for quite a few years. Where are you now in that journey, and how do we think about the next largest areas of investment in robotics in the warehouse network? Thanks.
Hey, thanks, Brian. This is Brian. Let me take the first part of that question on international segment profitability. So, if you've looked at the trends, we see quarter-to-quarter fluctuations certainly in operating profit in the international segment, but we're starting to see clear trend lines that are moving positive and above zero. And for each of the last 7 quarters, as I mentioned, we've had year-over-year improvement in op margin, and in the last quarter, operating income was up $1.4 billion versus the prior year. So, really, it is a lot of the same factors you're seeing in North America: lower cost to serve, greater contribution from advertising, improved selection, faster delivery speeds, which help drive consumer demand. And if you step back further, international is really a mix of our established countries where we've been operating for a long time, the UK, Europe, and Europe and Japan, and a number of emerging countries, including 10 new countries that we launched in the last 7 years. So there's a lot under the hood there, and there's different stories in each country. Each of them is on a different point in the path from launching to customer adoption to scaling towards profitability to then making consistent operating profits. So I think our expectations in each of those countries mirror those in North America, and we intend over the fullness of time that we're going to aim for North America margins, which are not static themselves. So we're happy with the performance. Glad to see a number above zero in many of the last few quarters, but really it's a story on a country by country basis that we're working hard.
On the robotics piece, what I would say is, even though we believe we have more expansive and advanced automation and robotics capabilities in our fulfillment network than other peers, it's so early with respect to what we're going to do automation and robotics wise in our fulfillment network. We're just at the stage right now where we're starting to roll out. We had about 5 or 6 very significant new robotics capabilities in the areas of stowing, picking, packing, and shipping that we have finally put into one facility to get the entire workflow. It's a facility in Shreveport, Louisiana, that was just launched a few weeks ago. And as I mentioned in my opening comments, we're seeing very encouraging results there. And of course, the reason why we're trying to have more robotics and automation in our fulfillment network is it allows us to ship more quickly, to ship more cost effectively, and to make conditions even safer for our fulfillment teammates than what they already have today. And I think something that the team has done in a very disciplined way, and I talked about this a little bit in my annual letter, my shareholder letter, is just they have been very thoughtful about defining what are the primitive foundational building blocks that you need that you can then use in lots of different combinations to build additional automation robotics capabilities down the road so that we can move even more quickly with the next generation of robotics capabilities. And that team is invested in those, and they're already working on the next generation. And the last piece I would add to that is we really do believe that that AI is going to be a big piece of what we do in our robotics network. We had a number of efforts going on there. We just hired a number of people from an incredibly strong robotics AI organization, and I think that will be a very central part of what we do moving forward too.
And the next question comes from the line of Eric Sheridan with Goldman Sachs. Please proceed with your question.
Thanks for taking the question. Maybe a two-parter if I can. Looking at the results in the commerce business, there's a clear sort of pattern emerging with respect to ASPs versus unit growth. Can you talk a little bit about what you're seeing in terms of consumer behavior and the propensity to be receptive to either lower ASP items or discounts among consumer behavior? And then the second part would be, can you talk a little bit about some of the strategic initiatives you're building for the long term around capitalizing on lower ASP items and the potential shift to more consumables in the base of consumption habits on the platform? Thanks so much.
Yeah. Hi, Eric. Thank you for your question. Yeah, you're right. Q3 unit volume was strong at 12% worldwide. It's pretty similar in North America versus international. And the consumer factors, we're seeing a continuation of many of the things we've discussed over the first or last few quarters. Customers looking for deals and are price conscious. This matches up well with our Prime events where we were, which were well received and saved billions of dollars for our Prime members. It also led to paid Prime member growth accelerating the quarter, which is hugely impactful for us. A lot of our best offers and deliveries are tuned to Prime membership, and it's the best deal in retail. So with all the benefits you get for the subscription price, so those are all positive signs. When you look at the split between revenue growth and unit growth, you do see some impact of the lower ASP products that we're selling, as well as some of the trade down that consumers are doing. But we take that as a real positive. Seeing the growth in everyday essential categories, which are really predicated on speed. So you have to have fast delivery to be able to sell those products to customers. And when you do, it results in a stickier consumer relationship, higher orders, building larger baskets, which help our ship economics, and repeat orders are stronger. So those are all positive signs, and we'll take any short-term degradation in ASP because what we're focused on primarily is free cash flow here, and we see the ability to unlock whole new elements of the consumer spend.
I'll just add, Eric, on the lower ASP strategy. There's an expression that we've used a lot of times over the years that it's easy to lower prices, but it's much harder to be able to afford to lower prices. And the same thing is probably true about lower ASP items. It's pretty easy to choose to supply them, but it's much harder to be able to afford to economically supply them. And so one of the reasons that we have been so maniacal about cost to serve over the last few years is that as we're able to take our cost to serve down, it just opens up the aperture for more items, particularly lower ASP items, that we're able to supply in an economic way. And when you layer on top of that, that broader selection, you layer on top of that faster speed and what we're able to do in getting items and fulfillment nodes local and close to our end customers, what we're able to do in expanding our same day network, which allows us to ship same day, but also is one of our lowest cost ways to ship, is it just lets us serve so many more of customers' shopping missions. And that's what we're seeing in our business right now. But again, I think there's a lot of opportunity to continue to expand that.
And the next question comes from the line of Colin Sebastian with Baird. Please proceed with your question.
Great. Thanks, guys. Good afternoon. Question on online stores. The third-party unit mix declined a little bit in Q3, which is unusual. So just wondering if there were any specific drivers of that shift. And then secondly, you made a lot of progress with the AI agents on AWS and for sellers and Rufus for buyers. I wonder, with all the underlying data that you have and leveraging those agent capabilities, if you could provide any perspective on what a next generation Alexa might look like, and your opportunities there to perhaps drive incremental revenues. Thank you.
Sure, Colin. Thanks for your question. On the first one, third-party sellers. Yes, the percent of paid units was 60% in Q3, and if you look over the last 2 years, it's essentially was at 59%, stepping up to 60%, stepping up to 61%, pretty much every second quarter. So what we're seeing, it's still in the tight band between 59 and 61, but what we're seeing is the impact of the everyday essentials. There's probably the 3P demand is still strong, and unit volumes are strong. It's just the everyday essentials tend to skew more to 1P than 3P.
And on your second question, Colin, around Alexa, I think we have a really broad number of Alexa devices all over people's homes and offices and automobiles and hospitality suites. We have about 500 million devices out there with a couple 100 million active endpoints. And when we first were pursuing Alexa, we had this vision of it being the world's best personal assistant, and people thought that was kind of a crazy idea. And I think if you look at what's happened in generative AI over the last couple of years, I think you're kind of missing the boat if you don't believe that's going to happen. It absolutely is going to happen. And so we have a really broad footprint where we believe if we re-architect the brains of Alexa with next generation foundational models, which we're in the process of doing, we have an opportunity to be the leader in that space. And I think if you look at a lot of the applications today that use generative AI, there's a large number of them that are having success in cost avoidance and productivity. And then you're increasingly seeing more applications have success in really impacting the customer experience and being really good at taking large corpuses of data and being able to summarize and aggregate and answer questions. But not that many yet that are really good on top of that in taking actions for customers. And I think that the next generation of these assistants and the generative AI applications will be better at not just answering questions and summarizing, indexing, and aggregating data, but also taking actions. And you can imagine us being pretty good at that with Alexa.
And our final question comes from the line of Justin Post with Bank of America. Please proceed with your question.
Great, thank you. Maybe a couple questions. Just on the cloud, are you at all capacity constrained, and will the new Trainium or NVIDIA chips, maybe even drive sales growth faster? And then secondly, Andy, I know there's been some competition from some of the more traditional retailers growing quickly online. Maybe talk about maybe the advantages that Amazon has with the fulfillment center distribution versus store distribution. Any thoughts on that? Thank you.
Well, on cloud, Justin, what I would tell you is that I believe we have more demand that we could fulfill if we had even more capacity today. I think pretty much everyone today has less capacity than they have demand for, and it's really primarily chips that are the area where companies could use more supply. And so, we're growing at a very rapid rate and have grown a pretty big business here in the AI space. And it's early days, but I actually believe that the the rate of growth there has a chance to improve over time as we have, bigger and bigger capacity. And I think that, one of the reasons I mentioned in my opening comments that, we have a very deep partnership with NVIDIA. We tend to be their lead partner on most of their new chips. We were the first to offer H200s in EC2 instances. And I expect us to have a partnership for a very long time that matters. It's also true that for customers that start to scale out their implementations on the inference side particularly, they realize pretty quickly that it can get costly. And it's really why we have pursued building Trainium and Inferentia, which is our custom silicon. And the second version of Trainium, Trainium 2, will start to ramp up in the next few weeks. And I think it's going to be very compelling for customers on a price performance basis. And we have a lot of customer interest. We have gone back to our manufacturing partners a couple times now to produce a lot more Trainium than we anticipated. Some of that, for sure, is due to the fact that we have very large demand, and we want more capacity and supply to be able to provide them. But a lot of it is that customers are excited about the price performance that they believe they're going to get in Trainium. So, I think it's a very significant opportunity for us in the AWS space, and it's going to be a very significant opportunity for customers. I think on the retail side, I'd start by just saying that we've always believed that competition is very positive and very healthy. It's good for consumers. It's good for businesses. It's actually great for innovation. And if you look at the retail space, it's a very, very large market segment. I mean, we have a pretty big retail business, and yet we're only about 1% of the market segment share of the worldwide global retail market segment. And still about 80 to 85% of that market segment share lives in physical stores. And so if you believe that equation is going to flip in the next 10 to 20 years, which we do, there's just a lot of opportunity, not just for us, but for several players. There won't be only one successful player. I do think that we have some elements of our customer experience that are really unusual and unlike others. I think we have meaningfully broader selection than almost all the players that you probably have seen and heard of. We have low prices with very significant deals that we go work with our third-party selling partners around key holiday shopping occasions. And then we have very significant advantages in speed of delivery to customers. And we just continue to see in every bit of testing and analysis that we do that the faster that we're able to promise customers that we can get them their items, the more frequently they buy and the more they actually use Amazon for their shopping needs. And so those are things that are pretty different. I also think we have a way of prioritizing customers that I think is unusual. Our orientation, our DNA at our core at Amazon starts with the customer and everything moves backwards from that. Any meeting you go to inside of Amazon, we're always asking ourselves, what do customers want? What do customers say? What do they not like about the experience? What could be better? And that customer orientation is very important, not just in how you take care of customers, but the world changes quickly all the time. And the technology is changing really quickly. And so if you have the combination of strong technical aptitude, propensity, and a passion for inventing, and then also a customer orientation where it drives everything you do, I think you have an opportunity to continue to build great trust in a business over a long period of time.
Thanks for joining us on the call today and for your questions. A replay will be available on our investor relations website for at least 3 months. We appreciate your interest in Amazon and look forward to talking with you again next quarter.
And ladies and gentlemen, that does conclude today's teleconference.
All right. That is Amazon, folks. Great call. Every single time Jassy in those final closing statements knows how to explain the trajectory of Amazon's business. So the thing he said at the end of the call that I think is really important to remember is, and this is a stat everyone uses all the time, but it's still really important. Brick and mortar physical commerce is still the majority of commerce on the planet. it's not e-commerce. Now, Amazon has a lot of the e-commerce share, but even that, doesn't matter as much given the international expansion that Amazon sees they have. Like if you go to different countries, it's not using Amazon as much. There's different vendors. Like when I went to India, Amazon was barely mentioned when I went to India. There's so many other different options people use because there's things that are native to different geographies. So, but what Jassy's final argument was at the end, now that their operating margins are up, and I didn't look fully through the balance sheet, but I'll find out tomorrow how much retail margins went up. If retail margins are going up, which I imagine they did, and that also helped with the conjunction of AWS margins, and the majority of the world is still physical in regards to commerce, Jassy's point at the end was just like, hey, we have a strong trajectory for growth just on the commerce business alone, outside of everything they're doing with AWS. Amazon right here at 195.40. I would not be surprised if Amazon jumps to 200 tomorrow and actually stays there based on this call, based on the numbers, based on everything they were able to show in terms of guidance. They beat on EPS, they beat on revenue, they beat on guidance, they beat on AWS, they beat on operating margins. It was a phenomenal quarter. And then you've got this long-term trajectory of commerce eventually coming over to the internet. And if Amazon even gets a tiny portion of it, these are trillions of dollars that are spent every single year within physical commerce that Amazon could be a part of. Another thing that's really important that he talked about are agents and AI. So not as specific as like Salesforce in terms of what they're doing with agents, but Salesforce like really relies on agents as a SaaS offering to other companies to boost their revenues. Amazon relies on it more so in terms of internally what they can do to get more productivity out of their teams, out of their employees, and ultimately out of the workflows that they push within the cloud sector of the business. Now, when he was talking about the cloud sector of the business, one of the things that I noticed that he also mentioned was that AI workloads are not just a like thing of today is kind of the point he was trying to make. He was trying to say over the next 10 years, if you believe in the roadmap on what AI can do for advertising, which is another part that Amazon beat on, what AI can do for productivity, what AI can do for language models, what AI can do to deploy different workflows inside of different elements of a company. He specifically talked about Prime, the targeting they're able to do with algorithmic recommendations so that people are more likely to use Prime, which means they're more likely to pay for Prime using AI. All of these things are not going away. Also robotics as well, 100%. And he touched on robotics at the end when he talked about AI, because not only is robotics important to Amazon from a warehouse perspective in terms of all the robots that they're using, not humanoid robots, but robots to deliver and ship products, but also robotic processing automation. This is one of the things that Path is really important in. This is also something Amazon's experimenting with internally inside of their organization. So I think there's just a long runway of growth is what Jassy was talking about. This is the opposite of what you get from Tim Cook. Now, I didn't listen to the Tim Cook, the earnings call from Apple, but Tim Cook doesn't really inspire this like massive vision of growth because they're contingent on releasing new products. Amazon's really not that contingent on releasing new products. They're contingent on making their existing services like cloud, e-commerce better and better. And e-commerce, people are always going to be shopping unless we get into a recession. So Amazon has that tailwind. Cloud, you have another big stat that's important. 85% of workloads are still on-prem. They're not on the cloud. So you've got that massive tailwind for Microsoft, Google, and AWS, but AWS is in the lead right there at $27.5 billion a quarter. I mean, that's just amazing in terms of what that run rate looks like. And then you've got operating margins that are going up, which is what he led with on the call. And the more those margins go up, the more their EPS benefits. Apple right here down about 1.9%. Obviously on the call, Tim Cook probably didn't say anything that was that amazing, which is why the street's a little upset right here. I'll go through the transcript tonight and see if he gave any details about the iPhone 16. I imagine he didn't. And so that's why the street's probably selling it off right here. But I imagine Amazon's going to get upgraded tomorrow. I mean, this was a stellar quarter. I don't see any red flags. I don't know if you guys see any red flags, but I think this was a good quarter. And that's why Amazon's doing well right now. Intel is still up 9%. Intel, good quarter, but the reason they're up 9% is because they're firing 17,000 people. So once I found that out, then it made more sense why Intel is up. But outside of that, numbers are good, not amazing. But I think if they were not firing 17,000 people, the street would not say that they would be ready to buy Intel. And that's why I think Intel is up right now. Hopefully Amazon brings the S&P 500 back up. Yeah, I think, look, Amazon is, I think Amazon is a shot tomorrow to get to 200. I mean, I think it's time. I think investors have been waiting for it. Everyone knows Amazon is one of the cheapest Mac 7s outside of Google right now, but it has none of the risks Google has from a DOJ perspective or from a search monopoly perspective, because Amazon, doesn't need to rely on a business fueled by fueled by search advertising. Now they have, things where the DOJ and the FTC get mad at them, but I don't think they're having an existential threat in terms of their business being broken up. AWS again, 27 billion. Advertising, 14.3 billion versus 14.3 billion expected. So that was good. One thing they didn't talk about that I would have liked Jassy to talk about is Twitch. I was reading an article the other day that Amazon's going to get rid of Twitch. And one of the reasons why the article was saying is Amazon's going to get rid of Twitch is because the level of content moderation on Twitch is really annoying for Amazon to deal with. I don't know how many of you guys keep up with Twitch and Twitch creators, but Amazon's banning Twitch creators every other day because people do really weird stuff when they live stream. And there's certain terms of service that Amazon has that you're not allowed to say certain words and all this stuff. And every other day, Amazon's banning someone. So the article was basically saying this is a headache for Amazon more than anything. They bought it for $1 billion back in 2014. I think Twitch 10 years later at least is worth 10 billion. I would imagine they've 10x'd on that investment. And I would imagine any of the hyperscalers would want to buy it in an instant. Now, the DOJ is probably not, and the FTC is not going to let them buy it. But if they could find a buyer for it, I wouldn't hate for them to get rid of Twitch because I don't really see the incremental value they get from it. It's not like Prime subscriptions increase that much. I don't know if they're making that much margin off of it. It's just this asset that they have. It's a good asset, but it's not the best asset. Really, their advertising comes from Prime Video, where they can actually sell advertising, and then advertising inside of the Amazon platform itself. Twitch is huge. I agree. I don't know how profitable it is. So if there's a world where they sell it, which I don't think is going to happen, but it was an interesting perspective, then I think that would be a tailwind for them as well, because then they could just move on and not have to deal with all this moderation stuff and just, focus on the stuff that actually matters at the end of the day. So great quarter for Amazon. If you own Amazon, I highly recommend going through the earnings call again and looking through it. This is a position that I would be comfortable building out in 2025. Tesla is first on my list in terms of Max 7 names I want to build out. I think Amazon's second. I think Amazon's second over Meta as well, because the one thing that scares me about Meta, and I'm a big Meta guy in terms of just bullish on Zucks, but if you looked at their income statement yesterday, $40.6 billion of revenue, 39.4 of that was ads. It's it's not really a diversified business. It's just a business that is really good with advertising. Amazon, I think, although AWS is the majority of the operating income, it is very diversified. And all they need to do, which is what they did today, is turn the dial up on the margins on this, and this, and you get the entire business that starts to grow. And that gets the street very excited. Google as well. A lot of their income comes from ads at the end of the day. Microsoft's a bit more diversified, but Microsoft's valuation is not as attractive as Amazon's. And then you just think of the long-term trajectory. I think Amazon has quite a future. And Andy Jassy's a rock star. He actually knows how to talk to Wall Street and explain his ideas and outline a vision, going forward into the future. Remember, AWS also, or he was the CEO of AWS for over 20 years. He was the second or third guy that was in the room in 2006 when they came up with the idea of Amazon Web Services. So he's been there for a while. He understands the Amazon culture. And I think he's, a very comfortable guy to trust when it comes to leading Amazon into the future. And the only fear is, in 2025, do we get a much more attractive price on Amazon if we have a recession? Because if we have a recession, people will not be buying as much on Amazon. So that's one thing, obviously, that we're all going to have to be looking forward to as well in terms of seeing what is in store for 2025. Okay, cool. Sam says Amazon is 17% of my portfolio with leaps. Yeah, I like it. I mean, this every single time, dude. You're never disappointed at their calls. Maybe their numbers aren't always amazing. Like last time, the numbers weren't the best, but you're never disappointed with their vision, their transparency, their ability to communicate, and how much they actually seems like they care about giving investors what they need to actually evaluate the business in a meaningful way. Nvidia's up 1.2%. I have no idea why. I didn't hear Amazon talking about CapEx in that call. Maybe I missed it, but for some reason they're pumping, even though SMCI is down. I have no idea why Nvidia is up right now. SMCI down another 4%. That means, or sorry, did I say Amazon? I meant SMCI. So SMCI right here is down 50% then over the past 2 days, 48%. They did talk about CapEx. Okay, then I missed it. I think that's when I was putting on my socks. Amazon, $75 billion CapEx and more in 2025. Well, I mean, maybe that's the reason why Nvidia's up. Google said the same thing. They're spending more on CapEx. Not all of that's going to go to Nvidia, but if Google and Amazon and Meta definitely said that. That I know for a fact. Meta did say they're spending more on CapEx for their Llama 5 model, is what Zucks was talking about yesterday. in 2025, then that's all bullish for NVIDIA. That is very, very bullish for NVIDIA. Apple mentioned CapEx. Okay, so I didn't listen to the call, but if they did, that is also probably bullish for NVIDIA. They said it's a once-in-a-lifetime investment for the next 20 to 30 years. Yeah, that's pretty much what Zuck said yesterday. It's like, this is the time to put the money into the investment and just like, not worry about the expense, which is what a lot of analysts have been saying is like the catch-22. It's like, if they don't invest a lot and their peers do, then that the street's like, okay, sell them by the competitors because they're investing more in AI. But if they do spend a ton, but they don't show the ROI, then the street's like, all right, well, why are we spending our money on this company that it's not giving us an ROI? So really, it's a question of patience and just letting the AI thesis play out. And, over the next 10 years, I imagine if we let that thesis play out, we will see that ROI, and NVIDIA will have tons of demand to continue to build on that ROI. Amit, you said there was a new round of layoffs with Intel. Where was the actual news release to support this? So that's what multiple accounts reported. I believe Bloomberg was the source for that on layoffs. Intel did not put it in their press release, but no, yeah, it's definitely 16,500 employees. That's the number that we're seeing right here. Yeah, I mean, I'm looking at 3 very big accounts on Twitter that are pretty accurate when it comes to the news. So I would imagine it's probably in their statements. It's in the fine print. They definitely would not lead the press release with, hey, we're laying off 17,000 employees, but we did 13 billion in revenue. But it looks like they are laying out about 17,000 employees. Shout out to Derek. Hi, everyone. No free subscriptions today. I went bankrupt. Whole market's tanking. And so no subscriptions today from Mr. Wall. In terms of Bitcoin, speaking of Derek, let's see where Bitcoin's at right now. 70,003. Okay, so we saw Bitcoin touch 69. It's funny. Derek texted me today. He said, I think Bitcoin's going to touch 69. And we literally touched 69. We kissed 69 for hey, we didn't even make out with 69. We just kissed it on the cheek. 69,586. Now we're right back to 70,352. In general, the entire market, it took it on the chin today, but after hours, we are seeing a rebound. Coinbase rebounding, Robinhood up 1% after hours, MicroStrategy basically flat, Fubo's up 7%, and Novix is up 1%. You do have, a little bit of recovery. SoFi's flat, Qs are up 1/3%, Reddit's flat, S&P as well. Are we up green? S&P's green after hours. So the market is still relatively resilient given these earnings by Amazon and Apple were really good. Amazon's was very good. Apple's was good enough to at least say, nothing's wrong with Apple. It's just the future growth. The street's waiting on more guidance on that. And so it's not necessarily a reason to sell off this market and say, okay, things are too expensive. It's things are growing and at least justifying some of the multiple expansion that we're seeing right now. Derek said he sold the top 500 Bitcoin. All right. So if we do the math on that, let me just take out my handy dandy calculator. 500, let's assume 70,000. So that is $35 million, if I'm not wrong, or 72,000, wherever he sold it at. So maybe that 73,000 decline to 70,000 was because of good old Derek. I don't think that's all of Derek's Bitcoin, but yeah, this, you guys see this right here? This is probably what this is probably Derek at 7 a.m. in the morning selling $35 million of Bitcoin, and then boop, 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 boop. We get all the way right down here to 70,000. Now, look, I don't think it was Derek alone. I think there were other people that woke up and said they wanted to take some profits on Bitcoin. The question is going to be, is Trump winning for Bitcoin? And if he loses, the next question is going to be, does the Bitcoin ecosystem care if Kamala wins? And I think until Tuesday, we are not going to have an answer on that question. And so that's going to be very, very important to see kind of how that ultimately plays out. The good thing is the broader market, a lot of the crypto proxies aren't reacting negatively to Bitcoin today, but they all have run up a ton over the past 2 weeks. By the way, in terms of Trump and Kamala, if you look at the betting markets, it's getting tighter, folks. It's getting tighter. Let me just show this right here. It is Kamala's now at 42. She was at 37 at the lowest. It says 42. I meant to say 42. So 58.42 now. $131 million have been traded on call sheet. We don't know the exact amount traded on Robinhood, but Vlad did say they had over 10 million contracts yesterday. So that could be another reason that Bitcoin's going down a little bit if market's pricing in Harris over Trump. Again, objectively, whatever you think about Trump versus Harris, I think the market thinks Trump is more bullish for Bitcoin. But even if he wins, the market's going to have to figure out, is that a reason to pump? Because remember when he did that speech and Bitcoin just sold off, right? So like, I don't think anyone knows. Like November 4th is going to be one of those days, or November 5th, where there's just so much uncertainty. No one knows what the hell is going to happen. I'll be live the whole day. We'll see, kind of what plays out. But I can understand people selling Bitcoin before the election, selling their stocks before the election, and then just waiting on that one day to see what happens. It's a huge spread, yeah, but it's a spread that's getting tighter. And the question is going to be if it, continues to get tighter. And look, with Derek's 35 million, if Bitcoin does go down back to like 67, 68, I think he would be interested to buy. But 73 is hard to tackle because psychologically the market's got to allow us to break through that resistance. And all-time highs on any asset breaking through is not easy. So we're going to have to get back there. And I think the election is going to be the determining factor now over the next couple of weeks. Bay Ray says Amazon going to be 200 in the pre-markets probably. I agree with you unless the street gets scared about something. Amazon up 6% right here, 197. You could have bought it down 3% on the day at 186 too. So it kind of sold off into the close for, I guess, fear. I mean, I would imagine people were afraid selling it off into the close, and the election is one of the reasons they're afraid. And you have good earnings and it gaps up a lot higher. Now, here's the other thing. Whether Trump or Harris wins, these results by Amazon were incredible. So the question is going to be to the market, if someone wins that the market doesn't like, whether it's Trump or Harris, do they still think Amazon deserves to go back to 175 after putting up these numbers? We're going to see kind of how the market thinks of it, but it's another reason to remember that the election can't be the end-all be-all when these companies are putting up the results that they're putting up. So that's what we got on Amazon. All right, so that is it from me. I will be having a podcast coming out at 7 p.m. I think you guys will enjoy. It'll be a fun one, and it's about 32 minutes. I think you guys will like it. It was a good conversation. It'll be fun, and I'll be back tomorrow live on the market open 8:45 a.m. Earnings tomorrow. I don't think there's anything big in the pre-markets. We got some oil companies, Chevron, ExxonMobil. Tomorrow's November 1st, right? Yeah, wow, tomorrow's November 1st. And then we have nothing after the bell. And then Monday, we got Palantir. All right. That's it. Thank you, everybody. Appreciate it. How long away? 7 p.m. It's like 50 minutes, Tesla. So it's like in an hour. In an hour, it'll be up. All right. Thank you, everybody. Happy Halloween. Happy Diwali to everybody. I'm going to be with my family tonight celebrating Diwali as well after this. So thank you, everybody. Appreciate it. Hopefully you guys enjoyed the show. Hopefully you guys have been having a good week. I know Robin had tanked and that kind of sucks, but I think it'll be good by the end of the year. Right now, they just have to continue to execute and do what they have to do. And it seems like October was a good month for them. So, all right. I'll see you guys tomorrow on the market open. Bye, everyone. Have a good one.